It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges.
Was going to keep rain World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
As things stand, we're heading towards the first weekly loss in about a month on the S&P 500, but still a lot to play for. Thursday, Friday, and a ton of economic data. Equity futures are down by 0.2% on the S&P. On the Nasdaq 100, we're down by a third. Just a little bit lighter, heavier, negative on the Russell, Lisa. We're down by 0.5% on a Russell.
It's after a massive rally, and how much is this just simply people who are hedging their bets for Octobers that tend to be messy and are complicated by a whole host of other factors right now versus true concern about some sort of weakening in the labor market, or is it that the Fed's not going to cut rates as aggressively? Take your pick. They're both sides of the discussion that are still at play and are on opposite sides.
Fantastic conversation with Adam Posen of the Peterson Institute just moments ago, raising the risk to 2025 and making the argument that the Federal Reserve needs to communicate to market participants and the general public now about the risks associated with the prospect of increasing interest rates again next year.
2 points here. One is that the baseline neutral rate is actually substantially higher than people expect, including the Fed, that there is more underlying inflationary pressure and growth. And the other side is that a lot of the policies that are being proposed all will be inflationary and deficit increasing. So in order to get ahead of that, the Federal Reserve should be at least telegraphing that they're sensitive to that particular risk. They're not going to do that. The first side, I think a lot of people are debating, but it continues to be a debate in markets.
We talked about this with Adam. It reminds us of the situation that Governor Carney found himself in back at the Bank of England in 2016. And his central argument when he spoke out was the right one. It would leave the economy more prone to bouts of inflation. It has done. But it wasn't without costs. It attracted the wrong kind of attention to the institution. We can talk about whether it led to reputational damage. That's the kind of conversation that this Federal Reserve is very, very nervous about having.
Problem is right now we haven't seen it play out in the bond market. We haven't seen longer-term yields rise in ahead of some sort of increase in the deficit or ahead of some sort of policy shift. And without a bond market freakout, you can't have the central bank step in and say they need to respond to it. It's almost saying, look, the bond market needs to do it first before sort of give the Fed cover. And that, I think, is sort of in the popular mindset.
Well, there's no freak out right now. Bond yields are higher by just 2 basis points on a 10-year. Let's call it 380. At the front end of the curve, up a single basis point. In and around 365. Very, very range-bound through the week so far, with lots of economic data behind us and still tons of economic data in front of us. We mentioned the Bank of England. It's now Governor Bailey running that institution, and this is what he said about pound sterling a little bit earlier on today. The prospect of getting more aggressive on rate cuts. Speaking to the Guardian newspaper, the pound down by more than 1 full percentage point, 131.
And honestly, he's joining with everybody else, finally realizing if inflation's coming down, why not cut rates? You're facing off with the potential deterioration. Although, interestingly, after the United Kingdom was left for dead after Brexit, suddenly it's showing a bit more strength than even the Euro region, and we're actually seeing some more positive outlooks coming from the Bank of England. So just sort of an interesting backdrop as they look to try to keep that going rather than torpedo it with higher rates.
Potentially the biggest one-day loss going back to March of 2023. For sterling against the US dollar. Under surveillance this morning, President Biden saying Israel must hold off from attacking Iran's nuclear facilities in retaliation over this week's missile barrage. Biden also saying G7 nations agree Israel has a, quote, right to respond, but they must respond proportionally. Israel carried out more strikes in Beirut overnight. What does that P word actually mean in reality?
I think this means basically stay out of the nuclear facilities. President Biden made that very clear yesterday. You know, we were talking to Stephen Cook, and I mentioned this article that Tony Blinken, the Secretary of State, talked about how the strategy from the Biden administration has put the U.S. in a much stronger geopolitical position. Well, his deputy, Kurt Campbell, was talking yesterday, and he had this to say. The region is really balancing on a knife's edge, and there are real concerns about an even broader escalation or continuing one, which would imperil not only Israel, but our strategic interests as well. When he says strategic interests, you've got to think it's the energy market, especially ahead of an election.
You just have to wonder how much Israel's going to go it alone at the same time that they haven't really been taking a lot of cues from the U.S. But broadening out, what does that mean given all of the players who do not want to get involved in this versus the ones who are sort of at the table here?
Peter Cheer raised this at Economy Securities. We talked about this yesterday. Israel, over the last few weeks, has demonstrated superior defense, superior attack, superior intelligence. And he raised the question, why would they stop? Why would they start where their enemies are ultimately on the back foot right now?
One thing that I don't have a clear sense of is how much more does Iran have? What potentially could be holding them back with respect to some red lines for the U.S.? They could potentially withdraw support. Basically, Iran still has a lot of missiles. Iran still has a lot of firepower. And ultimately, do you want to have a peaceful situation, or do you want to have a full-on war where there's a lot of damage and a lot of death?
Speaking of red lines, red headline on the Bloomberg, Libya, the oil minister says oil output to resume on Thursday. Good timing, given what we've seen on this screen in the last few days.
But this just adds to this fact that this is why oil, even though we are seeing such an escalation in the Middle East, there's still a ceiling on it. Because why? There are cheaters. There's a Wall Street Journal report about that, with Prince Abdulaziz really wanting to hunker down on some of these individuals who are fudging their production output. And now Libya is saying, well, we got our act together. We're going to add more barrels to the market. So if you're concerned about prices going higher, potentially you can wait, because there's also the demand story in China.
Crude just off session highs off the back of that. I wanted to squeeze in this story. OpenAI has completed a deal to raise $6.6 billion in new funding, giving the AI company a valuation of $157 billion US. Thrive Capital and Microsoft leading the round. The deal is one of the largest ever private investments and makes OpenAI one of the 3 largest venture-backed startups. Just phenomenal numbers.
Yeah, you start talking about what the other startups are. It's something like TikTok and the likes that you've seen with similar types of valuations. You just wonder, again, how much do we understand the application of, say, ChatGPT and the future iteration of this? There was one investor, Mashiosa-san, who came out and basically started saying that it will cook your dinner, it will order your groceries, it will clean your home, and it will organize your children's homework. So if the AI can do this, I'm all in.
Given what Apollo said just yesterday, maybe this company stays private and never goes public.
Because it's not a matter of private equity, but rather equity that stays private.
Let's turn to this story. The East Coast port strike continuing into its 3rd day. No negotiations between the ILA union and its employers are planned. Port owners under pressure from the White House signaling late yesterday they're open to new talks. Major trade organizations, including the National Retail Federation, calling on the White House to intervene in the port strike, writing in a letter, quote, "This has now become an issue of both economic and national security. The strike will cost the economy billions of dollars a day, impacting businesses large and small. The administration must now step in to not only get the ports open again, but work with the parties to resolve the outstanding contract issues." Joining us now is Jonathan Gold, VP of Supply Chain and Custom Policy at the National Retail Federation. Jonathan, welcome to the program. Who do you blame for this? Are you going after the unions or the administration, the White House?
Look, at this point, the parties have been negotiating or trying to negotiate for a better part of a year. And unfortunately, the ILA walked away from the table in June. We need both parties back at the table to continue negotiations. At this point, now that we're in day 3 of the strike, the administration needs to use all of its authorities to get the ports open and get the parties back to the table and get a contract done.
Can you walk us through where retailers are currently at with regards to inventories and what the situation looks like at the moment compared to what it looked like the last time we had a real supply side shock a number of years ago?
So many retailers were preparing for this situation. You know, they were keeping an eye on the labor negotiations. Many brought product in earlier in the peak shipping season. Many shifted product to the West Coast ports. But even with some of that preparation, there's concern that the longer that a strike goes, the more of an impact it's going to have.
Jonathan, I'm seeing local reports in New Jersey that consumers are actually starting to hoard some items like toilet paper. Is it warranted?
Not at this point in time. Look, again, retailers are always planning for supply chain disruptions. They've got product on hand. At this point, we're not going to see impacts to the consumers for several weeks if the strike continues. Obviously, we need the strike to end, the ports to get open, and product to start flowing again. But at this point, we don't think there's a need for consumer rush.
When you say the White House needs to get involved, are you saying the president should invoke Taft-Hartley?
He should use all of his authorities. If they need to use Taft-Hartley, then that's the process they need to use. We look back to what happened in 2002 when we had an 11-day lockout on the West Coast ports, and President Bush at that point invoked Taft-Hartley. So at this point, whatever authority the president can use to get the ports open and get the parties back to the table, they need to use.
But Jonathan, do you think given the election, this administration in no shape or form is going to do such an act?
At this point, you got to look at the election, but you've also got to look at the national economy. JP Morgan saying $5 billion a day hit to the U.S. economy. It's not just the port workers who aren't working, but the potential for other industries to be hit pretty significantly, as we've got inputs to production that are coming through these ports. You've got our farmers who are trying to get product to market. All these industries and companies are going to be impacted. So we've got to take a look at the betterment of the national economy to get these ports back open.
Jonathan Gold of the National Retail Federation. Jonathan, appreciate your time. We're going to continue this conversation around the table with Neela Richardson of the ADP Research Institute. Neela, good morning.
Hi, good morning.
I wanted to share these numbers with you from Anna Wong of Bloomberg Economics. If the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls by as many as 80,000 jobs. How do you read between the lines what's going on here and what it might mean for data in America?
I think the bigger effect of a prolonged strike is really in inflation. We talked about how maybe a policy change just a few minutes ago with Adam Posen, how a policy change could actually affect the current level of prices. Well, this strike would have an immediate effect on price changes. And that's going to play into an immediate response by the Federal Reserve that they will have to be active about. So in terms of the labor market, for us, it probably won't have an immediate effect at ADP because remember, we're counting the number of people on payroll. And so whether they're striking or not, if they're part of payroll, they're getting counted. For the BLS, it will have probably a more pronounced effect because they are counting the number of people who are getting paid. And if they're striking, they're not getting a paycheck. What does that mean for the economy? If you have a significant number of people who are not getting paid and the knock-on effects of other industries, other businesses affected by the strike, then you have something that is much more vulnerable for what has been a pretty resilient consumer. And so it is troubling. The more prolonged the strike, the more vulnerable the U.S. economy.
And it's basically everything that the Fed doesn't want. It's a stagflationary shock because you said it could potentially cause inflation to go up and potentially could reduce people's spending power. Where in particular could you see inflation really rise quickly as a result of these strikes if they go on for a while?
Well, that's fairly uncertain. It's hard to predict. But if you go back to what really triggered inflation in 2021, it was not just the fact that there were supply chain logjams and you couldn't get production. It was the fact that you couldn't get people to take stuff off the boat. You couldn't get those things from the dock into the store. If that returns, then we have an inflation picture that is not just based on services, which it has been for the better part of a year, but goods inflation now starts to rise. Goods inflation, which we thought we'd solved. And so that raises another specter in October, and we don't want that. No one wants that.
When does it start, though? Because a lot of people who talk to say there's a little bit of a gap they have. There's some leeway here. When does it really start to hurt?
Again, the timing is uncertain. I would think if this lasts 30 days or more, we're starting to get into some real price impact, but there's no way of knowing right now how long that would take. So I think that uncertainty alone has an economic impact. It's funny because we kind of reached a nirvana, at least when we looked at the ADP data in September. Everything kind of came together into this nice equilibrium, and it looks like it's going to last about 2 weeks. Something else is going to happen to topple us from this equilibrium, and that's why the Fed it really can't pause, it really can't go to sleep. It's very in the moment, it's very data dependent, and it can't think long term right now because there are all these other things, from oil prices to striking workers, that could tip the scales again and tip up inflation.
That's exactly where I wanted to go. Yesterday we got the ADP report. Some people are saying that it's actually more accurate these days with respect to predicting what non-farm payrolls, which is not a goal, I know, of the ADP report. But how vulnerable were those figures to some sort of disruption, to the downside? In other words, do you think that the risks, like the Fed, are truly skewed to weakening, to the downside when it comes to the labor market?
What we saw was a rebound in employment. We went from a revised 103,000 in August to 143,000. It was the first time that 9 out of the 10 super sectors that we follow all posted job gains. The only one that slumped was information services. So we were really cheered by this report, also because wages had stabilized. So we got all these job gains without a noticeable increase in pay growth. So I call this economic nirvana for the Fed. This is exactly what they wanted to see. More jobs being created, but not a big pickup in wages that could tip over into inflation. Now I don't know for October what's going to happen. And so I'm not sure that this economic nirvana in September can be sustained.
So you've got Andrew Hollenhorst on one side of the sphere saying basically you could see a real weakening that leads to recession. You have Adam Posen, you have many others, Jim Bianco, coming out and saying actually the risk is with a reacceleration of inflation and that there's a real concern that the Fed is being too aggressive in their rate cuts. Based on the data you look at, which is more accurate?
There's truth in the short and long term, and that's the hard thing for the markets to get around. I do believe that we are not going back to sleep on inflation for the next 2 decades, that periodic bouts of inflation is now part of our new normal. But at the same time, we've seen inflation come down a lot. We're not seeing wages pick up. We're still seeing healthy hiring. And when we talk to clients at ADP, both small and large, what we're hearing is what we heard over the summer was a bit of stasis. Like, I'm not sure. There's so much uncertainty. I don't know when the Fed's going to cut. I don't know how much. Maybe I should delay hiring. Well, what triggered in September, what it looked like is that, okay, the Fed started the rate cut. Maybe I can go forward with my talent management plans. Maybe I can hire those new workers. And we saw a little tick up in the JOLTS report for job openings. We saw a little strength in the hiring, and that was good news. Now we're getting another bout of uncertainty. So that might mean that the head of the turtle goes back in the shell for a little bit when it comes to hiring.
Nita, appreciate the update. As always, thank you. Nita Richardson of ADP. What Nita said at the end there, I think is really important. The anxiety around the election. It's been a real story over the last few months when it comes to hiring. Is that going to change once we get past that hump in November?
Will there just sort of be this incredible surge in hiring and, frankly, in economic activity, regardless of who wins, as long as there is some sort of conclusion as to who wins? Interesting, though, that the rate cut also unleashed the same type of activity.
Well, that's the key point. If there is a conclusion, and we naturally know the outcome of this election pretty quickly. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The British pound is weakening against the dollar, with the currency poised for its worst day since 2022. This coming after Bank of England Governor Andrew Bailey suggesting the central bank could take a more aggressive approach to lowering interest rates. The governor's comments in an interview caused investors to bet on quicker reductions from the central bank, eroding the currency's appeal. Traders previously thought the BOE would be behind its peers on easing policy. Meanwhile, small donors are fueling the Trump campaign. It said it raised $160 million in September, with the majority of donations under $200. But the small donations were not enough to outpace spending. The Republican presidential nominee spent $12 million more than he raised during the month. This is the second month in a row that's happened. The campaign kicks off October with $283 million cash on hand. And 2 prominent Democratic senators have criticized U.S. Steel CEO David Burritt over his potential $72 million golden parachute if the sale to Japan's Nippon Steel goes through. Senators Elizabeth Warren and Sherrod Brown wrote to Burritt over their concerns, saying such payments, quote, demonstrate a repulsive conflict of interest in which U.S. Steel executives can enrich themselves at the expense of U.S. Steel workers. U.S. Steel has acknowledged receipt of the letter and says it plans to, quote, respond to correct its many inaccuracies. That's your Bloomberg Brief. John?
Thank you, Yahara. You want to talk about going after executive pay now? Is that what's happening?
Well, no, I know what you're going to say.
You're just going to go through every contract of the CEO on the S&P 500 and talk about how bad it is?
I feel like it's almost a badge of privilege for some people when they get an Elizabeth Warren tweet.
Is that what you think? I think they're like proud of that?
No, I don't know. I wonder if they're best. You know, how quickly am I going to get this?
Okay, let's move on. Up next on the program, bracing for a supply shock.
We have had a move in crude, let's call it 5-6%, since Iran has retaliated against Israel. but we're still very much at the bottom end of the range here in crude.
3-day rally on crude, the latest from Citi, up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Oil up for a third day. Crude right now 71.12 on WTI. Off session highs, we're up by 1.5%. Under surveillance this morning, bracing for a supply shock.
We have had a move in crude, let's call it 5-6%, since Iran has retaliated against Israel. But we're still very much at the bottom end of the range here in crude. This is not a market that's panicking too much about what will happen if there is a supply disruption, and that's because they are focusing on the OPEC plus spare capacity.
So here's the latest. Oil rising for a third day as traders assess supply risk in the Middle East. Israel expected to retaliate against Iran following this week's missile barrage. Eric Lee of Citi saying these developments add another layer of uncertainty to the oil market, with the ultimate impact on global oil balances and prices hinging on the degree of Israel's response. Eric is with us here in New York. Eric, good morning.
Morning.
Let's think about this. If they begin to target energy infrastructure in Iran, how many barrels are actually at risk? Do you have to think beyond just Iran?
I mean, yes, but actually Iran is really the starting point, right? Iran produces about 4 million barrels a day of crude oil and condensates. So any attack an actual attack to its oil infrastructure, hitting production or exports, would be a big deal. It's just that we've seen a number of steps before we can get there. However, this time we're a little bit closer than we were back in April, when it seemed like both sides were trying to somewhat de-escalate.
Aside from just calling whether or not this is going to escalate to the degree of some real fundamental disruption, it's fascinating to me that you see the upside band of oil prices at about $75 a barrel, and you see the more likely trend downward, that you actually think that prices will eventually get back to $60 a barrel next year. Is this because of U.S. production? Is this because of more use of alternatives? How do you understand the lack of impact that full disruptions would be this time around, at least as represented in the market?
Yeah, I mean, it's a bit of all of the above, but one big part of it is that markets have been artificially tight because OPEC Plus is holding something like 6 million barrels a day of spare capacity from the market. And they have a plan to bring it back, even if they might keep pushing it back. With that plan in place, with so much oil potentially overhanging the market, I think it's capped, provide a bit of a soft ceiling to where prices can go and capped upside volatility.
Can we go back to the Israeli response? If they go after the energy facilities in Tehran, we heard from our reporter in the region, Jumana, talking about the fact that maybe they're going to go for the domestic consumption. But then wouldn't the Iranians just move the 1.7 they export into the domestic economy?
I mean, here's where, looking at oil for over a decade, it's always like, sometimes people will liken it to a large bathtub, right? You shift oil around here, it sloshes around, and other things get impacted. So yes, it would get moved around, but then that would still tighten up availability for oil, crude oil or refined products elsewhere, depending on what the size of that is. So all of it would be something that causes oil to spike up somewhat, which is not what everybody wants at this point.
Do you see an Iran that's willing to compromise some of the trade flows going through the Strait of Hormuz?
Sorry, can you repeat that?
Sure. Do you see an Iran that's willing to compromise some of the trade flows going through the Strait of Hormuz?
Yeah, to us, that's always been the very, very low probability, high impact risk. I think in many ways, most people not dismiss that, but push that right into the tail, right? This seems like it would be very much a last resort where Iran would be, would be somewhat of a self-inflicted blow as well, but to impact everybody else. So if this does escalate, if Iran's own domestic oil facilities get hit, this would be one way that they could strike back at really a lot of players all around the world, but hurting themselves also in the process.
Given the potential tail risks, you talked about a potential cap to the upside in prices as well as volatility. What is that cap, effectively, that could be a ceiling even in some of the tail case scenarios?
So if we're talking about, so let's say if Israel does hit Iran's oil exports, it's about 1.5 million barrels a day. As I mentioned, OPEC Plus has a plan to bring back voluntary cuts of 2.2 million barrels a day over a year. They're poised to do so. There's a lot of talk as to whether they will start in December. But we do think that any sort of supply disruption, tighter conditions in the market are exactly the signal they need and the opportunity to bring back some of that oil that I think at least some of their members are quite eager to bring back to market.
Javier Blas of Bloomberg Opinion just yesterday, the oil price that matters now is 50, not 100. I'm sure you read that. He thinks there's a bigger risk of going back down to 50 than going to 100. Do you share that view?
Broadly speaking, yes. I mean, we've been calling for $60 oil next year really since earlier this year. That's without, this is assuming, actually, in our base case, we think OPEC Plus will keep pushing this down the road. They won't actually bring back in December. They'll keep pushing this back because market conditions are relatively soft. If they bring some back and non-OPEC Plus supply grows and demand disappoints, we could see a 5 handle. We could even see a 4 handle.
Wow. Eric Lee of Citi. Eric, appreciate it. Right now, we've got a 7. 71.29 on WTI. Lisa, Brent crude at about 75.
Just highlighting how different it is this time around from previous conflicts where people were calling pretty quickly for $100 a barrel in terms of crude.
Pretty big range. Yeah. Coming up on the programme, in the next hour of Bloomberg Savannahs, we'll catch up with Tracy McMillan of Wells Fargo, Tom Narriott of RBC, Lindsay Piega of Stifel, and former New York Fed President Bill Dudley with a bit of a mea culpa on the hard landing call. That's all coming up next from New York. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The Fed's laser focused on the labor market.
There's some slowing, but it's not contraction. It's not deterioration of the labor market.
These are still numbers that are very constructive for the labor market right now.
Everything's on the table for this Fed. You could get 225s if the jobs data are good.
The distribution of risks with respect to the labor market are clearly skewed to the downside still, even after this 50 basis point move.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, 30 minutes away from jobless claims. Your estimate, 221. The previous number, 218. For tomorrow morning, for payrolls Friday, 8:30, 150, the estimate in our survey. The previous number, 142. That's the setup for the next 24 hours. Equities, the scores, going into that, pulling back just a touch. We're down 0.1% on the S&P. On the NASDAQ, we're down 0.2. On the Russell, we're down 1/3. Lots of economic data in the next 24 hours, including another ISM services read, with a big focus, I think, Lisa, on the employment component.
Given that we saw the manufacturing employment component really surprised to the downside, that said, I do wonder where the balance of risks is. What we have seen is better than expected economic data increasingly come out. Most upside surprises going back to April. You wonder, is the bigger risk right now for equities the idea the Fed's not going to cut as much, or the idea that you get some sort of more serious weakening? I can't tell. Based on everybody who talks to us, they all line up on the opposite sides.
Let's explore that word risk. Risk. It cuts both ways. Crude, third day of gains, up 2% on WTI, 71.50 on Brent crude right now, 75.50, up by 2 full percentage points. When I say it cuts both ways, I'm talking about supply risk. That cuts both ways.
Well, yeah, because we just have a redhead now that Libya is ready to also add more into the market. Keeping a lid on this, then you have to take into the fact that you also have a number of cheaters. But we also talk about risk. It's not just the geopolitical risks in the Middle East, and we're waiting for Israel to respond. President Biden yesterday saying hold off on nuclear facilities. Everyone is now talking about maybe energy facilities getting hit. But a trifecta of risks right now when it comes to what's going on in the United States, when it comes to hurricanes and the dock workers.
There's a question about how much we've seen a changing in some of the affiliations, some of the associations of asset classes and events, whether it comes to oil and this question of what kind of knee-jerk response there will be because of the structural shifts in that market, or with respect to bonds as a haven asset, given some of the concerns that Adam Posen raised about potential reignition of inflation.
Remember that quote from Chairman Powell a few Jackson holes ago? Navigating the stars under cloudy skies, getting cloudier. They're not clearing, they're getting cloudier.
And yet his iterations have only been, his utterances have only gotten clearer. So there's sort of this question, what gives, right? But you're correct. Right now, these skies are about as cloudy as I can imagine. The fact that all of these incredibly intelligent people who I have incredible respect for come on and say the opposite things from one another. And I'm like, yes. And then another person come out, yes. You know, I mean, either could be correct. And that's sort of where we are.
Strikes, Boeing, across the ports, anxiety around the election, all holding people back from hiring people, you'd imagine. And you see that in the job openings. You see that in Joel's data this week.
What was fascinating was what Neela Richardson just said, which was that a rate cut, a 50 basis point rate cut, gave a lot of employers the willingness to go out and restart some of their hiring plans. Whether that fades now really quickly with the fact that you've got dock workers on strike and the hurricanes and some of the uncertainty around the election is the reason why she's saying we have no clue.
The opening bout just around the corner. Equities, your scores. Equities recovering just a little bit. We're down only 0.1% on the S&P 500. We've talked about crude. Here's a picture of the bond market for you. Up 2 basis points on a 10-year, 380.56. Coming up this hour, we'll catch up with Tracy McMillan of Wells Fargo, with equities on track for their first weekly loss in a month. Tom Narian of RBC, as Tesla's first quarterly sales gain this year still disappoints investors. And Lindsay Piegza of Stifel on the Fed's mixed messaging. We begin this hour with stocks on hold ahead of jobless claims in just under 30 minutes' time. The appetizer for the Fed's next big data point, September payrolls. Tracy McMillan of Wells Fargo saying September payroll growth is expected to tick higher. Likely no big surprises that will change the Fed's attempt to lower rates at a slow pace. We expect another 50 basis points of cuts this year and another 75 basis points of cuts in 25. Bottom line, now is not a time to rush to sell equities. Tracy joins us now for more. Tracy, welcome back to the show. Where do you want to be in this equity market?
Yeah, so we see choppy markets from here at least through the election. So what we're telling our investors is that look through some of the current risks and look out to our 2025 forecasts, where we do see upside potential for equities. So any pullbacks here related to these ongoing and emerging risks would be opportunities to position into equity markets. So potentially selling some short-term fixed income, some long-term fixed income, and reinvesting those proceeds in equities as we do see some potential for pullbacks here.
You've touched on how you'd fund that position. Let's get into equities just a little bit more. Last time we spoke, I think it was large over small, DM over EM. Is that still the case, or has China changed that story?
China has not changed that story, although we do think that the potential there is somewhat interesting. But we believe that the longer term, more secular challenges that China is facing with their property market, with very high unemployment for their youth population declines, those things we think are going to be difficult to surmount. So we do continue to like developed markets over emerging markets. We like U.S. over international.
At a certain point, when you talk about the U.S., you wonder how much you're betting on the Fed cutting rates aggressively, or you're betting on a more resilient economy that leaves the Fed cutting rates less aggressively. Which is better for your sort of more risk-on tone to come to fruition in 2025?
Yes, Lisa, we actually think it's the latter there, that the Fed won't have to cut as many times as the market is expecting because of a reacceleration in growth. So what we envision is that growth will start to slow some here towards the end of this year and into 2025. And then as monetary policy cuts start to take hold, we'll see a reacceleration into the latter part of 2025.
I have to wonder about what's going on right now with the equity market taking a breather, led down by the Russell 2000. This comes in tandem with a slight tick up in two-year yields. Basically, people in the bond market wondering if maybe they got over their skis, looking at some of the upside surprises to economic data. I just wonder if the rotation out of large cap into small cap, into the equal weight can continue if you get a less aggressive Fed.
Yeah, so we do think that is possible, particularly the rotation into small caps. So we are starting to build a position in small caps. We had been underweight small caps, significantly underweight for about 2 years. We're starting to build that position again because we do think that lower rates is going to imply a better credit availability, and just the reaccelerating growth will be a better environment for small caps going forward. We also think that that's going to foster a broadening of opportunities into quality sectors and cyclical sectors like industrials and materials and energy, communication services and financials. We think all of those sectors should start to benefit with that broadening.
Tracy, can you just pick up on the small caps point just a little bit? How are you recommending people play that? Is that through the index, through the Russell 2000, specific sectors like the ones you mentioned? How do you do it?
Yeah, so the Russell 2000 is a difficult index to invest in as a whole because the number of non-earners is rising in that index and approaching nearly half of that index. So we would be more selective going with fund managers who can pick and choose within the small cap universe, because not all of those companies are companies that we believe are viable.
You mentioned the financials. In 2 Fridays, we'll get some earnings from JP Morgan and a bunch of other banks as well. I want to go back just a number of weeks because that was a dominant story a few weeks ago, before the strikes, before the issues we see in the Middle East. It was what we heard from Ally Financial about maybe some credit issues. At the same time, we heard from JP Morgan about managing interest rate risk and what that might mean for the bottom line. Tracy, what do you think is going to stand out this earnings season?
Yeah, so we think that financials should continue to benefit from the front end of the yield curve moving down. We also think that as yields rise, we're seeing the 10-year starting to rise, we're seeing the 30-year starting to rise. That gives banks some ability to improve their net interest margins. So we believe that that is a good driver for the next 12 months for financials. This earnings season, the expectations have been ratcheted down. Analysts are moving their estimates down. We think that that's going to add to the choppiness for this quarter. And again, we look for any choppiness, any pullbacks, particularly if we get to 5,400 or below that. That represents a really good buying opportunity, we think, for U.S. large caps.
Tracy, how much are you just waiting for the election to be over and then you're going in and buying equities?
So we're not necessarily waiting, because typically we see the volatility ahead of the election, and then we tend to see equities rise following the election. So after that uncertainty is out of the market, that's when we see buyers coming back into the market. So again, looking for that volatility this month potentially to reposition into small caps, into large caps, and into our favored sectors.
Tracy, thank you. Appreciate the update from you and the team over at Wells Fargo. Tracy McMillan there on the equity market. How many people feel that way? Hey?
Oh, I'm sure. I mean, we talk about with companies, but how many other investors are basically getting call options and figuring out where they should, enter to protect against volatility, and then saying, it always rises afterwards.
We mentioned Scott Rubner of Goldman Sachs. There's the super tactical stuff over at Goldman on the equity side of things. I shared this quote earlier. It's worth repeating. I'm bullish on US equities for a year-end rally starting month-end, and I'm worried that my 6K target is too low.
Savita Subramanian came out with a note where she basically said, what seasonality? Usually this was a rough season, and it has been anything but. The sort of steady climb, the grinding climb sort of belies this feeling of volatility that we see with headlines and narratives.
Just a little bit softer right now on the Russell, on the NASDAQ, on the S&P 500 as well. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Heckes. Hey, Yahara.
Hi, John. The catastrophe modeling firm KCC is estimating the destruction destruction from Hurricane Helene will cost insurers $6.4 billion. Meanwhile, AccuWeather estimating the total economic damage could hit $160 billion. That would make it one of the 5 costliest storms in U.S. history. President Joe Biden and Vice President Kamala Harris are touring parts of the Southeast and announcing steps to bolster recovery efforts, with the death toll rising to 166 across 6 states. New York Mayor Eric Adams may be charged with additional counts in his corruption case. Prosecutors said it is, quote, quite likely that other defendants will be named in relation to the additional charges. Adams' lawyer has urged the federal judge to dismiss the case, calling it flawed. This coming as the mayor deals with growing pressure to resign. And Amazon plans to hire 250,000 people in the U.S. for the holiday shopping rush. The amount is unchanged from last year, an indication the company expects steady demand in its biggest market. In a move to entice recruits, the online retailer recently said it was raising hourly pay by at least $1.50 for 800,000 of its transportation and warehousing workers in the U.S. That would bring pay to more than $22 an hour for those workers. That's your Bloomberg Brief. John?
Yahara, thank you. We'll catch up with you again in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, plus we'll catch up with Tom Narayan of RBC as Tesla's first quarterly sales gain this year disappoints some investors, and we'll get his views on what is going on with some of the big automakers elsewhere after some big cuts to the outlook from the European players. That conversation up next.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
1 hour and about 15 minutes away from the opening bell. Equity futures pulling back just a touch. We're down 1/10% on the S&P 500. Let's get you some morning calls. First up, Deutsche Bank lowering its price target on Boeing to 195, citing negative impacts due to the ongoing machinist strike. The stock is down by only 0.06% in the pre-market. Your second call from Barclays, downgrading Stellantis to equal weight, pointing to inventory issues and eroding market share. That stock is down another 3.5%. And finally, Truist, raising its price target on Tesla to 236, seeing higher selling prices offsetting lower deliveries. Stocks nil down. That name is lower by 1.55% in early trading. Sticking with Tesla, Tom Narayan of RBC, keeping its outperform rating and writing this. For Tesla shares to be trading lower on an inline delivery print for Q3, in our opinion, makes little sense. This is not an auto business. Most of our valuation for Tesla is in autonomy. Whether it beats consensus estimates by a few thousand vehicles or not says little about the true value of this company. To talk about this industry, Tom joins us now for more. Tom, I think we need to take a giant step back before we get knee-deep in Tesla. It's been a phenomenal few weeks for this industry. We've had cuts to the outlook from Stellantis. We've had 2 in 3 months from VW. Pain elsewhere as well. How long before we see the same from Ford and GM?
Yeah, that's the question that everybody wants answered. I think it's a tale of two stocks between GM and Ford. Ford, interestingly, if you look at the dealer inventory levels, which is really what caused Stellantis to cut their guidance so substantially, Ford's dealer inventory levels are now above that of Stellantis. That's the bogey. That's the one we're the most worried about that could profit war next. The consensus is around $10.5 billion of EBIT for 2024, and the guidance is for $10 to $12 billion. It could suggest that that could be the next domino, but we would highlight a lot of the pain in Europe is isolated to Europe. Ford's Europe exposure isn't as substantial, and also China not as substantial, but we do think Ford could be next.
Tom, how much excess capacity do you think is in the auto industry right now?
Yeah, that's definitely an issue, especially on the EV side, right? That's why they're trying to cut back. Pricing is really at all-time highs, so they're trying to find excuses to cut production to to keep pricing higher. But as we all know, there's only so much production cuts you can do. Eventually, people have to buy the cars. And so, you know, they could try to cut production, but we do think discounting will eventually have to happen. And that's another reason why we think all these, especially the European companies, are cutting their guidance.
Tom, how different is the European situation for automakers versus the U.S.? You said that it was sort of a different situation. Can you elaborate on just how much it is?
Yeah, that is definitely true. You know, if you look at how the European automakers cut their guidance, BMW cited a supplier issue, which was, Conti. Mercedes cited China, the top end. VW, it was the European consumer. Stellantis, it was really the U.S. That was the one that maybe makes folks a little worried for Ford and GM. But it's really China and Europe that led the European cutbacks. There's also an old thesis of like, never let a good crisis go to waste. If everybody else is cutting, why don't you go ahead and reset expectations? In the U.S., maybe they're not thinking that way. But we still think that there's a good likelihood, if there's a price war in the U.S., that you could see it trickle down and impact the U.S. as well.
Tom, hold on a second. You said never let a good crisis go to waste, and I want to build on that. This idea that not only could you cut your price targets and your sales forecasts, but you could also cut staff at a highly politically charged time when that's very difficult to do, particularly in Europe. How much do you start to expect some of the cuts that we've already seen announced to only escalate, not only in Europe, but also in the U.S.?
Yeah, that whole debate is really raging, as you guys well know, in Germany and in Europe. We think that's probably more of a European thing. It tends to be some political theater, right? Because it's very difficult to do this in Europe because of supervisory boards and corporate governance, especially in Germany. So we do think that public debate tends to be more pronounced in Europe. But certainly in the U.S., if this price war gets worse, they're going to have to cut. They want to cut production before they cut price. So you could see it trickle into the U.S. as well. But we think that whole political theater seems to be, at this point, really based in Europe right now.
Well, one part of that is Ford going to Rachel Reeves, the Chancellor of the Exchequer in the UK, asking for more subsidies. Is subsidies the answers to basically move these EVs off lots?
Yes, 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 and yes. The reason why European BEV sales actually going negative this year, which is surprising, is because Germany especially and other countries pulled their subsidies away at the end of last year. That's the key driver of BEV sales in Europe. As you guys know, next year, 2025, is the big CO2 regulatory cliff. These companies have to sell BEVs. It doesn't look like that 2025 cliff is going to get delayed. So the answer is European governments have to step in and push incentives, and that's why the European OEMs, the car makers, want the incentives. They're not calling for the delays, not all of them. They really want the incentives to come back. People want EVs in Europe. That's not the issue. It's just the pricing is just too high.
When it comes to the European market as well, we're supposed to get those tariffs tomorrow on China. What are you expecting?
it seems like that there will be tariffs. And as you notice, it is stratified based on the OEM. And for the most part, they have worked, at least from the language we've heard from the European OEMs. I think only 1% of sales in Germany are Chinese EVs. So they seem to be working. The issue will obviously be what happens in 3 years or 2 or 3 years when the Chinese actually manufacture in Europe, the Trojan horse in there. I think that's going to be the bigger threat. But it looks like the tariffs will probably go through stratified based on which OEM you're talking about.
Much to the chagrin of BMW and Mercedes-Benz, Tom, who do not want this to go through. They have said that vocally, in part, maybe only in part, to the fact that they have a huge proportion of their sales in China. What does the business model look like for German auto manufacturers if China puts up walls in response to the walls that Europe is putting up to their electric vehicles?
Yeah, it's definitely a net negative. I should note, though, that most of the production from the German OEMs in China is localized, right? It's through JV partners. But there certainly is a percentage, would say 20, 30%, that's exported from Europe. So it's definitely a net negative. The bigger issue, I do think, is the domestic competition in China is intensifying. The domestic players are doing really well. And what we saw from the Mercedes profit warning is they were commenting on softness at the top end. That was not supposed to happen, right? Are Chinese consumers favoring their domestics, even at the high end? I think that's the thing that has the German OEMs maybe a little worried.
Tom, where does that leave Tesla in that market?
Yeah, I mean, look, Tesla's actually doing quite well from selling cars, but certainly a tariff war is not great. We've seen what happened to Tesla numbers in Europe just this past quarter because of tariffs. It's already impacting their numbers. So look, it's definitely a net negative. They don't want a trade war. But, as you've commented from my report earlier, I don't think folks should be really caring so much on Tesla deliveries quarter to quarter. It's really more about other things, right? Autonomy, energy storage. And by the way, they're going to collect some regulatory credits because of the CO2 cliff next year, because I don't think a lot of these OEMs in Europe are going to be able to make the CO2 targets if the EV sales continue at their pace and if we don't get substantial incentives from the governments.
Interesting. Tom, we've got so much to talk about through the next 12 months. Looking forward to doing it again soon. Tom Naran there of RBC on the auto market. We've said repeatedly on this program, China, the most competitive market anywhere on the planet. It's got to be one, the automakers there. And the consumer preferences are shifting big time.
And they're shifting in part because the government is basically saying, shift them. And by the way, you want to buy the national champions. Question is where it leaves international players. I'm glad you asked about Tesla. Where does this leave Tesla? And ultimately, Tom's saying, look, the proposition there is not as a car manufacturer. You have to be betting on some of this other technology that really is what will drive this company, no pun intended, to the valuations that it has.
The politics of all of this in Europe. How many times have we said either they're going to cut capacity and cut it big time, or you need big time state aid? It's kind of one or the other right now.
And it's kind of the moment that they have to determine which it's going to be. Because if you think about BMW and Mercedes, I understand Tom's point that you've got a lot of domestic providers that are manufacturing these cars. Nonetheless, there must be a reason why they have come out so vociferously against any kind of tariffs, any kind of walls for Europe to put up to Chinese electric vehicles.
It's been a massive year for that industry, that's for sure. Coming up next on this program, jobless claims data 5 minutes away. We'll break it down right here on Bloomberg TV with Bloomberg's Michael McKee. We'll catch up with Lindsay Piegza of Stifel on the economy, and we'll speak to Jack Manley of JP Morgan, here to react and look at the markets from New York. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
60 minutes away from the opening bell. Cash open just around the corner. Equity futures coming back just 0.1% on the S&P, down 2 on the Nasdaq on a Russell, down 0.4% in about 15 seconds time. Jobless claims data. Mike McKee's going to break that down for you. The scores in the bond market look like this going into it. The 2-year, 365. The 10-year, 380.56. The number we're looking for in our survey, 221. The previous week, 218. With the economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, and it's one of those mornings where the data are slow coming out, but here we go. 225,000 jobless claims last week. That's up from 219,000. The 219 was revised up by 1,000 from 218. So basically, we're in the ballpark of where we have been for some time now, and it really doesn't tell us anything about where we are in terms of the overall labor market, other than companies are not letting people go. Now, this is obviously a seasonally adjusted number, so we'll see. I've got to get the release pulled up here to see if there is a big change in the unadjusted numbers.
Will you stay with that? I'll go through the price action. Yields are still higher. They stay higher, up 2 basis points on a 2-year, on a 10-year up by 2 as well. In the equity market on the S&P 500, some muted losses, mild losses going into this print. We stayed that way. We're down about 0.1% on the S&P 500. On the Nasdaq, we're down 0.2. If you put the data together this week, we haven't solved the conundrum. This is it. The ultimate dilemma for economists right now on Wall Street, trying to figure out what happens next. The quits rate is lower. The hiring rate is lower, but the layoff still remains low. So if you've got layoffs low, jobless claims low, we're having the same debate, Mike, we've been having for months.
Exactly.
And layoffs inevitable.
Well, if you're going into recession, they're inevitable. Right now, the unadjusted data show a decrease of 1,000 in unadjusted jobless claims, which suggests that we didn't see any kind of bump in layoffs that were smoothed out here. Continuing claims, 1,826,000, are down 1,000 from the week before. So the jobless claims side of the employment ledger does not suggest that we're seeing a labor market deterioration.
Do we care about challenger job cuts, which also came out earlier this morning? I mean, is there any signs that we are seeing on the margins, layoffs just picking up just a little bit? Or do you think that in general, we're sort of in this, as Neela Richardson said, this sort of economist's nirvana for the moment that could be pushed in either direction?
Well, it's a kind of a difficult situation to analyze challenger for a couple of reasons. One, they are worldwide. U.S. companies, but their worldwide labor force. And a lot of the job cuts are done through attrition rather than layoffs. So they don't really give you a clear picture of what's going on. When you see a change like that as well, you notice they're up by 53%, the job cuts, but also we had Amazon announcing it's going to hire 125,000 seasonal employees and target 100,000. And so those aren't incorporated into it. There's a lot of churn in the labor market. So Challenger doesn't really provide that much useful information.
Jobless claims this morning, 225, the estimate 221. The previous week, a revised 219. Into tomorrow, payrolls. The estimate in our survey, 150. The previous month, 142. Mike McKee, thank you, sir. With us now is Lindsay Piegza of Stifel. Lindsay, let's talk about the numbers that just came out. Anything to fear? Anything to worry about looking at the labour market data through this week?
Really not yet. The jobless claims seem to be pretty steady. We have seen a little bit of weekly volatility, but nothing to indicate a sizable directional trend. Right now, we continue to see that the labor market remains tight-ish, with some indications of cooling momentum. But again, that cooling suggests the data is simply moving more towards a neutral state as opposed to an indication of mounting weakness as we look further to the end of the year and turn that page into 2025.
Where do you get any degree of confidence that we'd stabilize in this state at this level?
Well, I don't think we're going to get much confidence from jobless claims per se, at least not the weekly data that we've stabilized. Big confidence is going to come from more improvement or more stabilization in the non-farm payrolls report. So Friday is going to be a very key driver, not only for confidence for investors, but for the Fed officials looking to make that determination of what's the appropriate next move for November and December. If we see more indications of cooling momentum, I think that's going to bolster the case for a larger, more aggressive second round 50 basis point cut. But if we see more steady conditions, if we see more stabilization, that's going to make it pretty difficult, coupled with earlier uneven inflation data from the PCE, to justify anything beyond a 25 basis point cut. And should we see the numbers come into the upside, I think the Fed may be willing to sit on the sideline and take a pause in November.
Forgive me, because I've been conditioned by experience, Lindsay, but every time we're heading into a non-farm payrolls, everyone says this is going to be decisive. It's going to tell us where we are in terms of on the brink of some sort of deterioration or some, steady as she goes type of state. And then it comes out and people find 15 different narratives to justify within that same data. Lindsay, why should this be any different?
Well, I think, again, it's not the end all. It's not the deciding factor for November, but it is one of the key pieces. We have a handful of key data points between now and November, and the Fed is going to look at them in their entirety. So coupled with the idea that the PCE, yes, it's a key driver, but it was mixed. It was uneven. The headline retreated. The core showed further upward momentum. Now, we're going to turn our focus to the labor market. If the labor market comes in very clear to the upside or the downside, that's going to be a very key driving factor to that decision. But again, if it comes in mixed, the Fed is likely to say, well, we need more indications. We're going to wait for a next round of inflation. We're going to wait for the next round of the employment data. So it's not that one data point is going to make the decision, but each of these data points becomes increasingly more important as the picture is not yet clear as to what the Fed should be doing and the size and the momentum of these policy adjustments that the market is anticipating.
Lindsay, how much salt, though, needs to be thrown on the next data point of the non-farm payroll report on November 1st?
Well, there is going to be some adjustments that have to be taken into account. Of course, the port strike, of course, the hurricane, all of these events are going to provide additional volatility. But it's likely that we do see most of that volatility not necessarily hit the November report. It may take an additional month to come through. That being said, if we did see that type of distraction or volatility, the Fed can also look through that. So yes, there is some amount of we need to look at the data point with a grain of salt, given the underlying factors, these one-off effects. But the Fed is smart enough to look through that. They're going to see the underlying directional momentum. And again, that's going to help decide where the Fed policy needs to go from here.
What's your best guess for tomorrow?
I think we are going to see something similar along what we saw last month. I think 140, 150,000 is very reasonable, keeping us on par with, again, the pace of job creation, raising the 3-month average closer to around 130,000. But the unemployment rate still steady around 4.2%, well below what the Fed has designated as that full employment range or the sustainable level of joblessness. So I think we get a somewhat favorable report still indicating tight-ish conditions and still indicating the need for a very patient, tempered, controlled reduction of rates as, again, inflation their job of reinstating price stability has not yet been met.
Lindsay Piegza of Stifel. Lindsay, thank you. Essentially the message we got from the chairman earlier this week, we're in no rush, we're not in a hurry.
Which was the reason why people thought, well, maybe we got a little bit ahead of ourselves. Then, of course, you have Andrew Hollenhorst right on cue, comes out with this. Jobs data to give direction, basically saying low initial job lists show layoffs have not picked up, but that may change. He continues to predict 70,000 for tomorrow, which
downside
definitely
risk.
Yeah, exactly. Which, you know, is a different scene.
Mr. 70K over a city, unreal. With us around the table, Jack Manny of JP Morgan, far more bullish than that. Jack, it's good to see you.
Good to see you too.
Layoffs, they're low. Are they inevitable?
I'll echo your sentiment, right? Which is that it kind of depends where you're looking in this economic cycle. I think at the moment the business confidence is there to keep people employed, and the layoff numbers that we've been seeing on a weekly basis have been reinforcing this narrative that the labor market is quite tight for where we are in this economic cycle, right? People are not losing their jobs. Payroll gains are still positive. The unemployment rate is moving higher because of a supply side problem, not because of a demand side problem. I'm not particularly worried about layoffs at the moment, but talk to me in 6 months, it could be a completely different story.
So we had the conversation this morning whether a good number would actually be good news for this equity market. I sense from what you're saying it would be.
We'll see about that. I actually think we're back in this kind of like perverse environment where bad news is good news. Which
we flipped again.
I think we flipped again because when you look at what's going on, I mean, this is like it's unhinged, right? So the market right now, the market right now is calling for what 125 basis points of cumulative easing this year. So another 75 basis points after what the Fed has already delivered back in September. And when we, John, you mentioned earlier some commentary from the chairman that they're not in any rush. There's no real worry. I mean, how do you adjust the dot plot from 25 basis points to 100 basis points of easing over the course of 3 months, and then add another cut to the cycle by the end of 2026 and say, hey, we're not worried about anything? That to me is telling, very telling about how the Fed in particular thinks about what's going on with labor. And what's even crazier to me is that in the aftermath of that June summary of economic projections, right, the Fed tells us 25 basis points. The market says you're full of it. It's going to be 100. Then the Fed comes out and says, okay, you're right, it's going to be 100. And the market says, no, it's actually going to now be 125 or 150. If we see payroll gains come in tomorrow at 150,000, if we see the unemployment rate stabilize at 4.2 or even move a little bit lower, I think that narrative for 125 basis points of easing continues to deteriorate. And when we talk about inevitabilities here, John, I don't know about an inevitability with layoffs, but at some point, this game of chicken between the market and the Fed is going to come to a head. At some point, somebody's going to be right on this one. And my guess is the 100 basis points is probably closer to the truth than the 125. And as soon as markets come on board with that, you got volatility all along the curve, you got volatility in the equity market.
So just let's stay with the whole idea of now good news is bad news for equities in particular. That's basically what you're saying, right? That basically you start pricing out interest rate cuts that are outsized, that is going to be risk off. Okay, I guess I'm trying to wrap my head around something when really everyone was telling us that if companies are in a good economic situation, that is good for these companies. If inflation is a little bit hotter, that is good for corporate earnings. Doesn't it all come down to corporate earnings more than anything else, and we're just basically rearranging the deck chairs ahead of earnings season?
Without a doubt. I mean, it's earnings and in particular what's going on with margins. And I think the differentiator in this conversation has to be the market versus pockets of the market, right? We know that the market, by and large, has been driven by a very small handful of names. That story has changed a little bit in recent months, but generally speaking, driven by a very small handful of names, gassed up on this idea that AI is going to fundamentally transform the world, lofty valuations, pretty impressive earnings expectations, but the S&P 493 or whatever it is that you want to call them are much more fairly valued. And so I think if we're looking at the market in aggregate and we're worried about valuations in aggregate, then this change in expectations around interest rates may put a little bit of downward pressure on the overall entity of the S&P 500. But that doesn't mean that the rotation that we've been seeing in the market is not durable, because exactly to your point, Lisa, the overall macro trends I think are actually quite supportive. You have cooling wage pressure, which is good news for corporate America. You have easing inflation. I would agree we're not completely out of the woods just yet, yet, but I think with inflation stabilizing, that's good news. And we have falling interest rates. And if that's 100 basis points or 50 basis points, anything's better than 0 basis points. And that's all good for a broadening out, I would say, of profitability.
So basically, this is short-term versus long-term. That short-term good news is bad news for the markets just simply because of where we've gone with valuations. But over the longer term, if the economy is stronger, even with fewer rate cuts, you still see this rotation into the other 493, into small caps, even potentially continuing.
That's exactly right. And I think the one other thing I'd sort of add to that story that ends up being a little bit confusing is, we see an economy, right, that is very clearly cooling off relative to above-trend growth in the back half of last year. And I think the labor market is an excellent leading indicator of exactly where that coolness is coming from. How can you make the argument, right, that a slowing economy is going to be better news for the companies that haven't been doing well? And I guess my pushback would be, if the U.S. economy grew, 4.5% annualized in the back half of last year, and these companies couldn't do anything, then I guess the proof is in the pudding, right? That higher interest rates, that hot inflation, that warm wage pressure matter more than overall economic activity, than GDP growth. So a cooler economy that avoids recession, right? I mean, that is like the biggest thing we have to point out. If there's a recession, this story changes. But as long as there's no recession, then all those things that I mentioned earlier, that kind of trifecta for profitability, it is great news in the long term, and all the stuff we're dealing with right now is noise over the short term.
Do you think we get less noise or maybe more clarity after the election, this narrative that a lot of companies are holding back on hiring because they want clarity on November 5th?
I think that normally that's how we would think about things. I mean, when we talk about elections and politics in general with our clients, we always like to say, elections are profound sources of uncertainty. And markets, more than anything, hate uncertainty. Markets don't care who wins, right? They just want to know who's in charge. They want to know the composition of governments they can plan for or around any potential policy change. And so in general, a good kind of rule is election day happens, you know what government's going to look like, and then all of a sudden you're kind of back off to the races. I would say that this year, I mean, I know this time it's different or whatever, you shouldn't say that kind of thing, but this is clearly a very unusual year. There are a lot of other headlines swirling around out there. And I would make the argument that the election is not the thing that everybody is most concerned about at the moment. Maybe it's tied with a few other things, but it's not like, oh, once that's over, everything else is back to sunshine and rainbows. There's plenty of other stuff for businesses and consumers to be worried about.
Jack, it's good to see you.
Great
Thank
to
you,
see
sir.
you
Appreciate the update. Jen Manley there of JP Morgan. Jobless claims. No bad news here. No bad news here. Equity futures right now down 0.2% on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Recapping that labor data, U.S. jobless claims picked up slightly last week. The data is at a level consistent with a limited number of layoffs. Initial claims increased by 6,000 to 225,000, higher than the median forecast in a Bloomberg survey of economists, which called for 221,000 applications. Meanwhile, continuing claims were little changed. Starbucks is bracing for climate change, the company announcing plans to buy 2 new research farms in an effort to make coffee more resilient. Starbucks said a farm in Costa Rica will look into solutions, including how technology can help farmers. Meanwhile, the other farm in Guatemala will replicate the challenges facing the small farms that make up 97% of its supply chain. In September, extreme dryness in Brazil sent prices for beans favored by Starbucks to their highest level since 2011. And people familiar with the matter say Miami Dolphins owner Stephen Ross is working on a deal with private equity firm Ares Management and billionaire Joe Tsai. The deal would include stakes in the team and other assets at a valuation of $8.1 billion. A potential deal would be the first private equity transaction after the league changed ownership rules earlier this year. The Dolphins, the NFL, and Ares declined to comment. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with the former New York Fed President, Bill Dudley. That's just around the corner from New York. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Around about 40 minutes away from the opening bell, equities pulling back by 0.2% on the S&P 500. As we count you down to the cash open, the trading diary for the rest of the week, the calendar looks like this. At 10 a.m., factory orders, durable goods and ISM services. Then at 10:40, more Fed speak from Kashkari and Bostic. And tomorrow, it's payrolls Friday, the next big data point for the Federal Reserve. Elsewhere on the Federal Reserve, the former New York Fed President Bill Dudley, in a new Bloomberg opinion column, writing this: I've been too pessimistic about the risks of a so-called hard landing for the U.S. economy over the past few years. Although most of my conclusions that led to that view were correct, such an outcome remains very much in doubt. Bill joins us now for more. Bill, welcome back to the program, sir. It's been quite a journey for you, an intellectual journey over the years so far. I want to go through a couple of headlines, and you help me understand why you've changed your thinking somewhat. It was only back earlier this summer where you said, I changed my mind, the Fed needs to cut rates now. Before the Federal Reserve meeting last time around, you said they need to go big now. I think they will. They did. This morning, my hard landing forecast turned out to be wrong. Bill, just walk us through how you're thinking about things currently and what kind of policy this backdrop needs.
Well, my original view was that the Fed would be late to tighten monetary policy. Check. As a consequence, inflation would go up and the labor market would get very tight. Check. Then the Federal Reserve would have to tighten monetary policy a lot. Check. And the unemployment rate would have to go up at least a half a percentage point, trigger the SOM rule. Check. But the SOM rule trigger doesn't seem like it's leading to recession. If you look at the GDP numbers, they've been very firm lately. Second quarter, 3%. Third quarter is tracking 2.5%. So even though I had the story right, it doesn't look like the conclusion is going to pan out. It's too soon to say for sure. That's why the labor market has so much attention focused on it. And I thought what was interesting, the summary of economic projections at the last FOMC meeting, they actually, in their summary of economic projections, they actually think that the downside risks to the labor market are actually greater now than the upside risks to the inflation. So they're worried about the exact same thing. And that's why tomorrow's labor market report is so important. If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. And that's why the Fed cut 50 basis points a couple weeks ago.
I think a lot of people, Bill, share your journey in terms of changing views and not understanding which models are actually accurate this time around. What in your analysis makes you think that this time is different and that some of the classic indicators that traditionally have foretold recession no longer work?
I think two things are different. Number one, you had all these fiscal transfers during the pandemic to businesses and households. So business and household balance sheets are in better shape than they typically are late in the business cycle. For example, look at debt service costs for the household sector. Still pretty low because people locked in very low mortgage rates during the pandemic. Second thing I think is different is that financial conditions have eased a lot even before the Federal Reserve cut rates. So financial conditions were at the most tightest about a year ago. And since then, they've eased a lot. Stock market up, bond yields down, credit spreads tighter. And so even though monetary policy is tight, when you look at the level of short-term rates, financial conditions have eased a lot, and that's supporting economic activity.
What's to say we're landing it all, Bill?
Well, that's a good question. I mean, I think, the Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that very, that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
Bill, what are you expecting for tomorrow?
I think it'll be a decent payroll employment report. I mean, I think the estimates are around 140,000. That seems like a reasonable estimate. We have to remember, though, the payroll employment has a big standard error around those estimates. So you could get something like 80,000, or you get something like 200,000, and it really wouldn't tell you for sure that the economy has actually changed momentum.
Bill, how difficult is that November 7th meeting going to be, considering how messy the data might be, considering we might not have an outcome from the election? Can you think of a time like this one that they're going into in the next month?
Well, the particular awkwardness is that there'll be another payroll employment report during the blackout period right before the FOMC meeting. I think the risk to inflation, monetary policy is tight. We're still quite a ways from neutral. So 25 basis points is the most likely scenario in my view at this point.
Bill, we had Adam posted on earlier from the Peterson Institute, who said that the Fed should be vocal about the fact that they're considering the deficit and potential tariffs as a potential inflationary pressure heading into 2025 and a reason to cut less. What do you make of that? Not necessarily the Fed weighing in on that particular issue, but being more cautious ahead of next year because of it.
In my experience, the Fed doesn't, set policy today on things that might or might not happen in the future. I think they wait till those things either materialize or not. And so I think that the idea that the Fed wouldn't ease because they're worried that the election could result in a certain outcome that would lead to higher tariffs and higher inflation, I don't think the Federal Reserve would hold off because of that.
Bill Dudley, appreciate it, sir. As always, the former New York Fed President Bill Dudley there on his latest piece, How My Hard Landing Forecast Turned Out to Be Wrong. You can find that on Bloomberg Opinion. Bill's lived this going into the 2016 election, and coming out the other side, we were all talking about tax cuts in Washington, and the Federal Reserve just had to wait to see the campaign promise to become legislative reality.
Right, and they're going to have to wait this time around too, and essentially everyone's saying they're not going to really weigh in on this. That said, just taking out tariffs, taking out the potential for an expanding deficit, there is an issue of whether we have underpriced the inflation risk, given the fact that everyone is saying this economy looks very different than it has in the past, and you're seeing very easy financial conditions. That, I think, is a real important takeaway.
It's a debate that continues. Coming up tomorrow, here's the lineup for you. Priya Misra of JP Morgan, Ellen Zentner of Morgan Stanley, Nadia Lovell of UBS, and Mohammed Al-Own of Queen's College, Cambridge, and a whole lot more. The lineup is absolutely stacked as we count you down to payrolls Friday. This is the number we're looking for. In our survey, the median estimate 150, the last number 142, and I imagine it will solve absolutely nothing as we go into the Federal Reserve decision next month and a big election still to come. From New York City this morning, good morning. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason I love thinking about black swans, and at the office everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China, all of that is in our interest. And whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Futures are down. Volatility's up 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Janali Bassick on assignment. Bloomberg open interest, though, it starts right now.
Coming up, markets are on edge. Investors await Friday's jobs report for clues on the Fed's cuts as tensions remain high in the Middle East. Levi's slumps as the denim maker lowers its revenue growth outlook for the full year. And the CEO, Michelle Goss, joins us in the next hour for a C-suite conversation. The stock has gotten decimated. Plus, a warning sign. Credit investor Victor Koshla tells Bloomberg there's a tsunami coming through in U.S. office real estate. Let's take a look at where markets are trading right now. In terms of futures, as I said, we're looking at losses on the S&P. Not huge drops here, just a third of 1%, almost half of 1% on NASDAQ 100 futures. And you can see the 10-year yield climbing about 4 basis points right now at 382. So markets are on edge. As I said, volatility is much higher right now. Katie's got to look at some of the stocks.
You're seeing that volatility under the surface as well. If you take a look at the single stock level, as Matt mentioned, Levi Strauss falling in a big way. That's after it missed sales estimates. It lowered its full-year revenue outlook to the bottom end of its previous range. Shares currently down about 11% pre-market. Let's also take a look at Stellantis here. It was downgraded by Barclays amid profit concerns in the auto sector. That's worth a 4% decline. And then we do have a little bit of good news. We're watching shares of Constellation Energy. Remember, it struck that deal with Microsoft to power its data centers with nuclear energy. Now there are reports that Google is reportedly considering nuclear power for its data centers as well. That is lifting the whole sector, including Constellation, Matt, currently up almost 3% pre-market.
All right, let's take a look at that volatility that we've been talking about, because it's not atypical for the VIX index to rise in October, usually because of elections coming up. Options pros tell us, though, right now, that's not the case. It's really about the direction of the U.S. economy and, I guess, the size, we know the path, really, of Fed rate cuts. I heard Amy Wu Silverman on Bloomberg Radio this morning saying that even though traders think that the market is going up in terms of just the stock index itself, they're still buying a lot more downside protection than they typically do, and that's why we see volatility higher.
Yeah, it is really interesting. And of course, the textbooks would tell you that volatility up, stocks up, it can't happen. You can't have it both ways. So it'll be interesting to see how that shakes out. We are at a really interesting juncture in markets, though, right now, because, of course, we have the U.S. economy doing well. We have China stimulating their economy. But at the same time, we have all of these geopolitical conflicts that we're worried about. And of course, we also have that port strike still going and expected to last. So a lot of cross currents here, and you're really seeing that in the month of October. It has not been too pretty.
Yeah, no, and don't forget the hurricane, right? So we've got the problems in the Middle East, you got the port strike, you got the hurricane, the election coming up, and then the Fed. Let's bring in Jack Janasiewicz, Natixis portfolio manager and lead portfolio strategist, to talk us through some of these things. Of those headwinds, Jack, can we put the Fed really away? I mean, we know the Fed is cutting, right? Maybe they're not going to do 50 basis points again in November, but they're still likely to go 25.
Yeah, and again, thanks for having me on, Matt. And you know, the key there is simply that the Fed is easing. And I would actually widen back out that scope and say, you've also got the ECB easing. You've had very dovish commentary from the Bank of England. You had some dovish commentary, you know, coming from the BOJ. You know, all in all, global central banks are all leaning towards one way, and that is dovish easing. Throw in that fiscal stimulus that potentially could be coming in size from China. Those are some pretty good tailwinds. And so the geopolitical stuff tends to fade away over time in the near term. And those tailwinds that we just sort of highlighted with central banks' liquidity support, I think, is going to be the big driver going forward here.
So what you're saying is, I mean, typically we have some election volatility, especially ahead of a presidential election year. And now we have geopolitical adding to the dips. You want to be a buyer of those dips?
You know, absolutely. And I would even argue maybe the best thing for the markets in here would be November 6th, right? We're finally past that election point. And even point to some of the things that we're reading in the ISM or in the Beige Book comments. Everybody's basically saying delayed but not destroyed, right? They want to get past the election backdrop, and then they expect to sort of resume normal business operations, so to speak. So delayed, not destroyed, pent-up demand. Let's get to November 6th here, and I think you're going to see the market start to get a little bit of its traction and head higher.
Well, Jack, of course, there's no guarantees that we'll know who actually won the election on November 6th, but that's a conversation for later down the road. Let's talk about that buy the dip impulse, of course, that you have here. Is that just a blanket buy? Or are there specific sectors, specific spaces that you would look for that opportunity right now?
You know, we're still focusing on the U.S. markets and really still staying up in cap. But I think from a sector perspective, you know, we think the cyclical value barbell with tech still works in here. So we think tech, you know, even though you potentially could get a little bit of broadening out in that breadth, which may put a little bit of pressure on some of the mega cap names, I still think some of those names will work. And then at the cyclical value side, think of things like industrials, financials, and to a lesser extent, even materials. We think those probably start to pick up some steam here as we head into the end of the year.
Okay, so if we visualize that barbell, of course, you've got tech over here, then you have cyclical and value names over here. Who's left out in the cold here? What does that leave out?
You know, that's still going to be your classic defensive plays in here. And again, we're still optimistic. We still think this is more of a soft patch. You've got that support from the Fed and global central banks. You know, we just don't see a real need to be leaning into defensives right now. So still staying in that growth complex, in the cyclical complex, and that leaves the defensive sort of left behind in here.
I got to ask your take on labor. In your notes, you lay out a big argument for what you understand the Fed is doing right now. Labor obviously is hugely important to them, more so than inflation. Are there really downside risks? Every time I talk to a small or medium-sized business owner, they say getting good labor is their biggest problem right now. They can't find workers that have the skills. The costs are too high, even with low skills. And there's a weak commitment. They can't get workers that are going to stay. Do we really have concern that they're going to, you know, we saw the JOLTS job openings number jump up to 8 million again. Are there really concerns about labor?
You know, I think the focus really should be on the layoff side of the equation. You know, when you look at things like the prime age workforce, you know, we're at cycle highs when you look at it in terms of labor force participation or the employment to population ratio. So that tells us that cohort of, you know, 25 to 54-year-olds, it's really never been higher over the last 30 years or so. So, you know, as we get closer to full employment, it becomes a little bit more challenging to add jobs. And so I think the more important thing to look at here is the layoff side of the equation. And we're just not seeing signs of that. And the big takeaway for us here is simply corporates need reasons to start laying off people. You've got margins expanding. You've got earnings estimates pushing higher. You've got maybe a soft patch that ends up dismissing itself and working back into a more normal level. Those, to me, aren't reasons why corporates should continue or start laying off employees in here. So maybe we're at this stasis where we don't have hirings, but more importantly, we don't have firings.
Yeah, and perhaps we saw evidence of that in the initial claims data that we got this morning, of course. Not exactly evidence of huge layoffs underway, but of course, we're all counting down to the jobs report that we get at 8:30 a.m. tomorrow morning. I'm taking a look at your notes, Jack, and you write about this asymmetry that has emerged with respect to incoming data, especially when it comes to the labor market. Walk us through that asymmetry and, of course, what you're expecting to see in the markets in reaction to what we're going to get tomorrow morning.
You know, I think good numbers will be considered good and bad will be bad. So when we think about the employment report coming up tomorrow, you know, if we get a number that's close to 140, 150, maybe even on the upper side 160, I think that's taken as a good sign because it gives a little bit more, I think, backing to the labor market, not really decelerating as fast as maybe some have been implying. If we get a significant miss or at least a weaker miss, that probably gives the Fed more room to actually continue to cut rates. So as the economic numbers decelerate quicker in here, I would expect to see the Fed starting to move up and potentially going a bunch of 50s in here. So the Powell put, that's, I think, the key takeaway. As the economic data potentially weakens, the Fed probably steps up its rate cutting cycle here. And I think that puts a floor underneath risk assets because of that.
And Jack, before we let you go, of course, this conversation focused on the U.S. That's where you want to be from a market perspective right now. Let's talk about China, though, of course, and that big measures of stimulus that we got. Maybe not a bazooka, but certainly, of course, a blitz of stimulus measures, not really making an impact in either way when it comes to U.S. markets. How are you factoring that in, of course, to this overall bullish view that you have?
You know, the China story really comes down to, you know, confidence in the economy and, you know, the transition or the linkages between the equity market and that confidence aren't quite as strong, I think, in China as it would be, for example, in the U.S. through that wealth effect channel. But, you know, we've seen in the past rates have come down, credit's been there, so it's not an issue of the price of credit or the availability of credit in China. It's more that confidence to actually want to borrow and actually do something with that. So, you know, addressing a lot of these concerns through the confidence channel, through credit, I'm not sure that gets to the heart of the problem here. I think the issue for us is you need confidence, which really comes on the fiscal side. So, yeah, the measures near term help the stock market. We're still waiting to see that big bazooka really come through on the fiscal side. And if we get the fiscal side, that, I think, changes the game here.
All right, Jack, always great to speak with you. Appreciate your time. That is Jack Janasiewicz. He is a portfolio manager and lead portfolio strategist over at Natixis. Meanwhile, we take a look at the futures right now. About 20 minutes to go until the bells ring. You can see we're shaping up for a down day in markets. The S&P 500 currently down about 0.3%. Something amazing happened yesterday, Matt. I know that you were off, but the S&P 500 was almost exactly unchanged at the close. Don't often see that.
I saw that, like 0.1% down at the close. I was off, but still paying attention.
Right, of course.
I was recording my podcast,
right,
which is called Bloomberg Hot Pursuit with Hannah Elliott. You can access that on Apple Podcasts or wherever you get your podcasts.
He wasn't on Open Interest, but he was working on another show. Meanwhile, let's get a look at stocks moving underneath the market. We're going to do that with Jess Menton right now. Talk to me about NVIDIA, of course. Jensen Huang saying some pretty bullish things.
And it's important to watch this stock, obviously, because of the weighting it has in the S&P 500. And so when you see this at a stock like this, it actually invested in OpenAI. And this came on the back after OpenAI said it had an investment round in the latest, earlier this week, around over $6 billion. And so that's important because this will give NVIDIA insight into basically how the chip processing is working for OpenAI. And then also when you think about the graphics processing that works when chips like this, that obviously gives that some insight into what they're doing. But also this came on the back after NVIDIA's CEO just said that the Blackwell chip demand is insane. And there were concerns, obviously, as we knew in recent weeks, about what that could mean for the demand moving forward. So you have this in the stock and pre-market trading. NVDA is the ticker symbol, up over 2%. If you look at other kind of chip makers in the space, AMD is actually up just slightly right now, around 0.1%. And then also Broadcom, though, down about 0.5%. So today it'll be important to watch what the SOX is doing because actually last quarter it was down over 5%. So it snapped about 3 consecutive quarters of gains there. But Evercore ISI actually made a call that they really felt like because of those declines in the third quarter, they felt like chip makers could rebound in the final 3 months of the year. So it'll be important to see how this kind of shakes up in the coming weeks.
It's kind of amusing that NVIDIA is moving on this pre-market because what else would Jensen Huang say? Yeah. Of course he would say there's crazy demand.
He's talking his book, but you know, it's only a 2%, which is
for NVIDIA.
I guess that's still a lot for a $3 trillion stock. I'm looking at HIMS. By the way, speaking of podcasts, I first discovered this company on Dax Shepard's podcast.
Oh, really?
Yeah, because
he's got a great podcast.
It's fantastic.
It really
it's my second favorite after my own, which is called Hot Pursuit.
What about my podcast?
I like the plug there.
I like it too, but
Oh, boy.
you know, so they used to make products just for guys. It was like about hair loss. I'm not sure if that really works. Erectile dysfunction stuff, but now they have hers also because they got into weight loss, right? They get into the GLP-1s. And while you couldn't get enough from Eli Lilly, maybe you were looking at options like Hims and hers.
Right.
But now Eli Lilly apparently has enough drugs.
And that was the big thing because the FDA back at the end of 2022 talked about how there was this drug shortage. And so there were companies like Him and Hers that benefited at this. But if you look at Hims as a ticker symbol, down about 12% ahead of the opening bell. So really this came after this weight loss drug shortage is ending for Eli Lilly. But if you look at BMO, they're making a call for Eli Lilly as far as what this could mean for their manufacturing. If you look at his stock, up about 0.2% ahead of the opening bell. But also that stock for Eli Lilly is up more than 50% year to date. So they feel like because this shortage is ending, that could really help their manufacturing capabilities. So that's really helping supporting the stock right now.
I do think if any company ever came out with a cure for male pattern baldness,
Oh my God.
that's like
Be
the
huge.
holy grail, right?
The white whale, if
Yes.
you will.
Yeah.
That would be huge. Jess Menton, we have to leave it there. It is always a delight to see you at the desk. That, of course, is Bloomberg's Jess Menton.
All right, coming up, President Biden warns Israel against striking Iran's nuclear facilities. They'd have to use bombs made here to do it. We'll bring you the latest next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Let's get now to high interest to look at what's making headlines around the world. LVMH and Formula One have signed a major 10-year sponsorship deal, potentially worth around $1 billion in total. The French luxury group has usurped Rolex's spot as one of the race's top sponsors. LVMH is upping its presence in the sporting world after being a major sponsor for the Olympic and Paralympic Games in Paris this summer. You could soon see Tag Heuer signs all over your F1 racing screen. Tesla is issuing its 5th recall in less than a year for its polarizing Cybertruck. The problem involves a delay in the truck's backup camera when drivers shift into reverse. Tesla deployed a software remedy last month to fix the issue. The company said the software issue affected only a small portion of an estimated 27,000 vehicles. And overnight in the Middle East, Israeli warplanes dropped bombs on Beirut after 8 IDF soldiers were killed in fighting around southern Lebanon. Israel claims to have killed 15 Hezbollah fighters in the strikes. While the conflict rages on, the U.S. has been urging Israel not to attack Iran's nuclear facilities in retaliation for Tehran's missile barrage. Katie?
The latest on the American response is Kayleigh Lyons. She is co-anchor of Balance of Power, joining us from Washington. Talk to us a little bit more about President Biden's response. Of course, when asked whether the U.S. would support such an attack by Israel, he said that the answer is no.
Yeah, look, Katie, the president has been very clear that the U.S. is going to continue to support Israel's defense, which includes things like helping shoot down missiles that were sent Israel's way earlier this week. The U.S. Navy was involved in those operations. Offense, though, is a whole different ballgame, and there is reluctance on the part of the administration not only to get U.S. troops more directly involved, but also to risk escalation. And that's what we have to consider when it comes to these nuclear facilities, because they are not easy targets. Iran has these facilities buried deep underground, so it would be very hard for Israel to actually reach them in a strike without the support of the United States. And I was speaking about this with Congressman Seth Moulton, who is a Marine combat veteran. He served multiple tours in Iraq, is very familiar with the Middle East. And he said the issue here is what Iran would do in response. If it has its facilities targeted, that could lead Iran to actually develop more quickly a nuclear weapon versus just the materials that go into a nuclear weapon. It's just unknown what kind of retaliation Iran could want to pursue in that scenario. In the meantime, of course, Israel, while it's still calibrating what exactly it wants to do to hit back against Iran, is continuing its operations in Lebanon. The IDF just put out a statement saying that Army fighter jets have struck targets belonging to Hezbollah's intelligence unit in Beirut as we continue to see the death toll climbing there.
I have so many questions around this nuclear issue, Kayleigh. I mean, I understand that Iran is still a year away from being able to make a nuclear weapon, or that it would take them that long to do so, and that the U.S. 2,000-pound bunker buster bombs would be needed in order to reach those underground nuclear facilities. But doesn't Israel already have those in its arsenal? And wouldn't the whole world breathe a sigh of relief if those nuclear facilities were destroyed, thus taking away Iran's ability to build a nuclear weapon?
But that's exactly what Congressman Moulton was trying to say, Matt, is that while it does seem like a simple solution, just take out their capabilities, there is no guarantee that their capabilities will be taken out entirely, and their response could actually be to double down and try to ramp up weapons production more quickly, considering they've just been developing the materials to this point. Now, when we consider Israel's ability to do this, yes, the U.S. is providing Israel with a number of things, has withheld some heavy bombs for use in Gaza over concern of civilian casualties there. But this is the real question of leverage that the United States has or does not have to exercise over Israel and its decision-making here. Because, yes, the U.S. is providing Israel with the means to defend itself, providing defense. If they were to take that away, it threatens Israel's existence if the U.S. looks like it's turning away from this ally that is facing threats not just from Iran, but from its proxies. On the other hand, that means it's very hard for this administration to actually influence the decision-making of the Netanyahu government. We've seen that borne out over the last several months as they've been pushing for a ceasefire, not just with Hamas, but more recently with Hezbollah, and Israel has kept on, keeping on, if you will, as they pursue their objectives here.
And Kayleigh, we only have about a minute left with you, but we should talk about what's going on stateside in the U.S. Of course, I'm talking about the port strike ongoing. President Joe Biden saying that it would be a man-made disaster to have a prolonged port strike, but he's walking a difficult line here, of course. I mean, the unions have said that they don't want him to interfere.
Well, yeah, and he is going to continue to support the unions. He is placing the blame here strictly on that of the port employers and the shipping companies, noting the profits they were able to rake in during the pandemic, saying that the union workers need a fair share of those profits. And he's telling these companies to bring a better offer to the table, essentially, in order to get these negotiations underway, because right now they are at the standstill. The union is maintaining, unless their wage demands are met, which is a 77% increase over a 6-year contract, they don't even want to begin negotiations negotiations on other issues, including automation, which may be more difficult to sort out. In the meantime, not just Biden, but Kamala Harris has to deal with the potential economic ramifications of it as we get closer to the election, while also not wanting to alienate the labor vote. And that is especially in focus for Harris today as she campaigns in Wisconsin and Michigan, blue-collar strongholds.
All right, Kaylee Lyons joining us from Washington with the latest. Appreciate your reporting, as always. Now coming up, climate-proofing your cup of joe. Starbucks has a plan for that. Details in our Social Climber segment up next. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, NVIDIA expanding its partnership with tech consultant Accenture in efforts to boost corporate AI adoption. Accenture has trained 30,000 experts on the use of NVIDIA's technology to help their customers use AI. Next up, Starbucks trying to make coffee more resilient to climate change. The company is buying 2 research farms in Costa Rica and Guatemala that will test everything from drones to microbes in efforts to combat drought and diseases. And finally, the Maui Fire Department is releasing the results of its official investigation into the cause of last year's fire. The conclusion is that the Maui fire was caused when Hawaiian Electric re-energized broken utility lines. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, we take a look at futures right now. Just a couple minutes until these bells ring, and boy, there is red on the screen. The S&P 500 down about 0.3%, a little bit more if you take a look at the NASDAQ 100, off by about 0.5% right now. Not seeing any relief, any follow-through to maybe some of the positive vibes that emerged yesterday. The Russell 2000, even worse, currently off by about 0.6%. Coming up, less than 4 minutes until the opening bell, we'll discuss the market moves with Ethan Devitt. This is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We do see futures pointing lower. Not huge drops, just 0.25% for the S&P 500, about 0.5% for the NASDAQ. Yesterday was virtually unchanged, but the arrow was still red. So after the almost 1% drop that we got on Tuesday, if we are down today, it would be 3 days in a row. Here's the New York Stock Exchange bell ringing right now. Front view ringing the bell down there. The NASDAQ market site, you've got I don't know.
Italian-American?
Italian-American.
Yeah.
Okay, they mixed up the letters there, so I couldn't really pull them apart visually. I have a dyslexia issue. I'm not sure if that affects it. In any case, we got the opening bells on both the New York Stock Exchange and NASDAQ Marketplace. Katie Greifeld, what do the indexes look like?
Well, I put the same indexes on the board every time, so not a lot of reading involved for me. Just numbers, and the numbers are going down. The S&P 500 currently off about 0.2%. The NASDAQ 100 a little bit more, 0.4%, and then a little bit more even if you take a look at the small caps. The Russell 2000 currently off by about 0.6%. Of course, an interesting juncture in markets right now. We had a really good September. October, can't say the same yet. Meanwhile, you take a look under the hood. Some stocks to watch right now. We have Levi Strauss falling in a big way after sales in the third quarter came in below estimates. That, along with the company lowering its full-year revenue outlook, has shares down almost 11% right now. We'll discuss all of it with the CEO in our next hour. Meanwhile, let's take a look at Stellantis. It was downgraded by Barclays in a review of European car makers. The analysts also downgraded Mercedes and Porsche as profit warnings in the sector spook Wall Street. Spooking shares of Stellantis right now currently off by about 4.7%, Matt.
All right, we're also watching shares. By the way, I am interested in those car stocks. I did hear that, and man, have they had a tough time lately. But I want to switch to nuclear. We're watching shares of Constellation Energy. It struck a deal with Microsoft to power its data centers through nuclear energy at 3 Mile Island. Now Google is reportedly considering nuclear power as well for its data centers. Let's discuss nuclear's potential resurgence with Bloomberg Intelligence senior analyst Anurag Rana, who not only covers the tech stocks for us, but also was a physics major. So Anurag, you know what you're talking about here. It's not surprising, is it, that Google would look to this power source, which has the potential to generate clean energy to power its data centers?
Absolutely right. So when you look at all these big tech companies, the one big pledge that they have done or taken is that they're going to be carbon neutral sometime down in the future. Now, if you're running AI workloads, if you are seeing more AI workloads coming into your data centers, I mean, what option do you have? You're not going to go out and go for a coal power plant. You're really going to need some kind of renewable energy. And, I think nuclear is one choice over there. But the only problem is you just can't whip up a nuclear reactor overnight. It's going to take a lot of time for that to really come to fruition.
Well, let's talk about that a little bit more. We were having this discussion in the commercial break. Just how long does it take to spin up nuclear? Because, as you said to me, it's not like you can exactly flip a light switch here.
Yeah, I mean, I'm, again, not an expert in nuclear reactors from that sense, but I would say at least a decade. But if it's a smaller one, maybe a little bit, lower than that. But it's not something that can be done over the next 3 to 5 years is the way I look at it. Now, at the same time, there are newer technologies in play, but we haven't seen any new construction of any of these in the last several years. So everybody's expecting some kind of a newer way to do this. But again, this is very uncertain at this point.
I mean, it's all about getting the energy, it seems, Anurag. Whether you're a Microsoft, a Google, an Amazon. I was just scrolling through Google's ticker. Apparently, they're tapping the Adani Group in India to get energy for their cloud services there. And then I, went in a deep dive. All these companies are looking to power their cloud any way they can. Is that, you think, a big play? Could nuclear or power generation be kind of the AI of the new AI play of this year?
I mean, in my view, it's not the new AI play. I think a lot of those stocks have seen a fair amount of jump in the last 12 months or so. One thing is for clear, we have seen a massive amount of interest by companies in AI. We just published a note that all the top tech companies over a 2-year period can increase their capex by about $65 billion. In 2025, they will spend somewhere close to $200 billion in capital expenditures. That's a lot of money going from a little over $100 billion 2-3 years ago. So where is all that money going in? It's going to expand their data center, buying chips, buying hardware, spending money on large language models, investing in places like OpenAI. So this is not something, in my view, that's a fad at this point. Everybody's investing in it. And power seems to be the biggest bottleneck at this point. And I think they are preemptive in terms of investing now so that they don't have that big shortage 3 to 5 years from now or longer.
All right, so it's not a fad, but specific to nuclear, it might take, about a decade to really scale up here. Anurag Rana from Bloomberg Intelligence, really appreciate your time. Meanwhile, let's broaden out this conversation now with Moneta Chief Global Market Strategist Ethan Devitt joining us now. And Ethan, you think about the U.S. market. On the good side, you have a strong economy. The Fed is cutting rates. You also have China stimulating their economy. Good signs there for the global sort of marketplace right now. On maybe the bad side, you have hot wars. You have supply chain angst. You also have election volatility. When you weigh all of those factors together, where are the scales tipping for you right now?
Interesting. We're starting to see a very different shift in how markets behave. Previously, the negative factors that you mentioned, the geopolitical volatility, the election uncertainty, and many of the factors just around the trading partners, that would have had a much heavier bearing on market activity and sentiment than it is today. And that's something that we're still trying to figure out why. Why are markets so resilient when these factors remain quite volatile and quite unpredictable? So in light of that, it is not wise to bet against markets. And certainly where that has been the case and investors have tried to exit markets at moments of volatility, that has shown time and time again not to be a winning strategy. So we are encouraging our clients to stay invested, stay the course, stay broadly exposed, which means not having everything on one theme or in some of the high-octane stocks or themes, and also to now be thinking quite sensibly about what to do with their cash. It was fine to sit in cash for some time. That clearly is going to start ticking down. So we're looking at some of the other, whether it be other fixed income solutions or bond substitutes, et cetera, that can be a slightly better way to diversify the portfolio.
Well, that's interesting, Ethan, because you think about cash on the sidelines, that narrative that's out there, and a lot of people point to that as bullish for equities, thinking that, that money that's in money market funds will eventually cycle back into the equity market. But it sounds like that's not the case for you, that you would put it right back into fixed income.
interesting. First of all, there has been a lot piling into money market funds. We've heard the 6 trillion number. We've also seen about 20 billion come out of money market funds in recent weeks. So that's a suggestion that investors are already not so enamored with what these money market funds can deliver. I would say not necessarily to put it into fixed income, because fixed income, the spreads are quite tight. We've seen that on investment grade as well as high yield. Perhaps they were tight because the absolute return, when you factor in the risk-free rate, was still quite attractive. So there was strong demand for these fixed income instruments. But now that that base rate is going to be coming down, they don't look quite as attractive any longer in light of the risk that's inherent in them. Remember, we haven't had those credit events. Nothing has been tested. So perhaps things are artificially robust. So what I'd say now is where we would go is not necessarily right back into equities, although we're maintaining our equities. It's starting to diversify back into those bond substitutes that have received very little love recently, and that's things like real estate, real assets, infrastructure, things that do pay a dividend-like income stream and should be quite resilient to inflation. Inflation hasn't gone away. It's not at double digits any longer, but it's still there, and we still need to make sure that portfolios protect their purchasing power.
I want to shift to the China issue, Ethan. Katie mentioned it on the positive side of the ledger, and we did see the CSI 300 rise, I can't remember, 8 or 9 days in a row.
I think it was 9.
It was 9, no, 9 days, exactly. It was 9 times that we saw it. In any case, so much optimism and momentum in Chinese stocks that hasn't really bled into the U.S. market. And I think one of the concerns is that they just aren't pulling out all the stops, right? The Chinese aren't doing as much as they possibly can. Now, apparently, there was an interview with the former head of a research institute affiliated with the Ministry of Finance in China, Jia Kang. He spoke with a Chinese publication called The Paper and said he could see Beijing putting as much as 10 trillion yuan into public spending, which is like $1.5 trillion. If they come out with such big stimulus, really following up what we saw last week with more, exponentially more, do you think that then has really positive effects on U.S. stocks as well?
I don't see it having much effect at all on U.S. stocks, actually. It's quite insulated from there. Most of our investors are quite, I'd say, cautious around China. They're cautious around emerging markets. They don't necessarily want Chinese exposure. They're watching from the sidelines. I don't think anyone will bet against China and its ability to stimulate the economy. Even when you look at staggering numbers, like the number of ships being built in China versus in the US, it's a ratio of something like 243 to 1. The Chinese economic story is explosive and always has been. We know from EV numbers a similar thing. The issue is, do US investors want a piece of that action? And so far, we really haven't seen that. What will be interesting, though, is perhaps a negative for China is the outcome of the election. And we know that certainly the rhetoric on both sides is not particularly friendly, but on one side, it's a lot less friendly overall to any form of more of a trading relationship. So I'd say that is something that's a negative for China. So not many investors on these shores are picking over the spoils of China's markets right now.
Ethan, how do you expect the U.S. elections to play out in U.S. markets?
Well, I'm not sure that's really my pay grade, but certainly for U.S. markets, I've mentioned before the resilience of markets. I don't think, will be as resilient as we would have expected going into this, in that we can see that there's a lot more volatility now, given the uncertainty. Your own columnist, John Authers, speaking about the potential for an October surprise. There always is some form of a surprise. And with the geopolitical rumblings that are quite severe in the background, there's a lot of uncertainty now baked in to this month of October coming. And as I've mentioned before, this election is very much binary in terms of what's likely to happen around the impact on trade, trading partners, and tariffs equals inflation and GDP compression across the world. So that is going to have negative impacts.
Ethan, thanks so much for joining us. Monetta's Chief Global Market Strategist, Ethan Devitt, talking to us about markets and in relation really to geopolitical risk and benefits.
Yeah.
Coming up, FrontView and Standard Aero both went public yesterday as JP Morgan says the market for IPOs is very open. We'll talk to Bailey Lipschultz about this next. This is Bloomberg.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot of it. To just give you very superficial ideas, and but at the end you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I feel that, when a designer doing is the spirit, is the heart that the computer don't have.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Let's turn to the IPO market now. Shares of FrontView, a REIT, continue to fall on their second day of trading. The company focuses on businesses in high-traffic locations. But earlier today on Bloomberg Television, we heard from SVP's Victor Koshla about his outlook for the property market, specifically office.
In office in the U.S., there's almost a tsunami coming through. You don't see it in the headlines quite as much, but underneath those debt maturities we were talking about, they are causing us an on.
Bloomberg's Bailey Lipschultz covers IPOs and joins us now. We have a couple to talk about, but I wanted to focus on this REIT first because of Koshla's comments. It has office in it. Aren't there concerns about commercial property?
Yes and no, Matt. I think when you look at the portfolio of the company, it was a smaller IPO, only about $250 million raised. When I talked to REIT investors in particular, they were meeting with the company, but they did kind of call out, it's a smaller float in terms of the shares listed. It's not a big company, so the allocation was not necessarily kind of groundbreaking, but it is interesting nonetheless to see a company that does have a form of office or your traditional retail-facing REIT going public again when we saw Lineage, the biggest IPO of the year, going a few months ago.
So that was interesting, of course, to see a REIT come to market. Let's talk about Standard Aero. This was interesting for a couple reasons. First of all, they raised $1.4 billion in their IPO. At first, I was like, that isn't that much money. But then I saw your size and scope in your story.
It's still a lot of money. Yeah.
I mean, I wouldn't say no, but it's the best performance for a U.S. IPO, raising more than $1 billion since Toast all the way back in 2021. Yeah. This was very well received.
Well received, and the thing we were keeping an eye on, Katie, was would it outperform ARM, which had so much fanfare going public last September, and clearly it did. This is one of the big IPOs that we saw investors really circling. This is Carlyle back. They were exploring a dual track. Would they sell the company? Would they take it public via IPO? When I talked to the CEO yesterday, he really applauded Carlyle going the IPO route, and I know a number of investors who bought the stock who said, we don't want this to get bought by another private equity firm. We want this company to go public because we love the business. We love the comparisons against a GE Aerospace. We saw Lohr go public earlier this year. The aerospace area has been phenomenal.
Well, it's also interesting that they decided against a sale, that they would rather go the IPO route. I feel like maybe that's a little bit of a sign of the times.
I think the big question comes back to valuation and valuation expectations. Could you get a few more turns going public via IPO than being an outright sale? Yes, but what do you value? The cash in pocket that you can return to LPs. We've seen such a kind of backlog of exits for private equity, but it does seem like that really is opening up. That's something we're watching, especially this month in October.
I noticed one of the investors in OpenAI in our story yesterday was like, this is great news for the IPO. Like, he's already there, you know?
I mean, it's a huge company. We're already talking.
That would get me excited. $157 billion?
Right, but I mean, NVIDIA's worth $3 trillion. Surely OpenAI can get a much higher valuation when they have all of the public clamoring for their shares, right?
Yeah, I mean, that's a name that retail is going to love. I think the big question when I talk to late-stage private investors who shied away from OpenAI is when they want to see a 3x in 3 years or 5x in 5 to 10 years, the question is, how big can OpenAI get and how quickly? And obviously, we've seen so much turnover within management that there still are questions there, but nonetheless, a phenomenal business and a huge valuation.
So looking forward here, not exactly to OpenAI, but of course, coming back to Standard Aero, Carlyle backed. You had a really interesting interview with the JP Morgan Chase banker who was basically saying that when you think about the window for PE-backed IPOs, it's wide open here.
It's wide open, that's what he said, and that's something, again, that we're going to be watching. Partners Group is bringing KinderCare public next week. CVC has a stake in Move Lubricants, who's expected to price next week. Ingram Micro has been a name that we've been tracking, platinum backed. So we're seeing a number of companies going public, and as Keith Canton from JP Morgan had said, next 10 to 15 days will be critical for those PE-backed companies, and that really could set the tone for 2025 when we expect a more open IPO market. But again, we've been talking about the IPO market being a few months away from opening up for about 3 years at this point.
Well, I'm sure plenty of those PE firms were really happy to read that interview, of course, looking for an exit here. Bloomberg's Bailey Lipschultz, always a great time seeing you. Now, coming up, the Miami Dolphins are nearing the NFL's first private equity deal. We'll discuss next in today's Wall Street Beat. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a look at how stocks are faring about 22 minutes into the session. Not too well. The S&P 500 currently off about 0.3%. You take a look at the NASDAQ 100 trying to go green here. We are back to just about unchanged on the big tech index. Can't say the same for the small caps. Of course, the Russell 2000 deepening its losses right now, currently down about 0.9%. We'll continue to keep an eye on that one, but it's time now for the Wall Street Beat. We are nearing the NFL's first private equity deal because Bloomberg was first to report that Miami Dolphins owner Stephen Ross is said to be in advanced talk with private equity firm Ares Management and Alibaba Group chairman Joe Tsai to sell stakes in the team. Now, sources say that the deals include other assets and could be valued at $8.1 billion. Let's discuss with Bloomberg's Randall Williams, who broke the story. And this was pretty fast. I feel like we just had the vote.
Yeah, the vote happened in August, and now we have a deal in October. It's like less than 40 days later. It's pretty quick.
So in terms of the valuation, it seems to me huge. I'm an older man. Is this how much NFL teams are worth now? $8 billion?
Well, the average, according to Sportico, is around 5. This is massive, and it also includes the outside of the Dolphins. It's Hard Rock Stadium, it's the Grand Prix, it's the Miami Open, which is a tennis tournament. So there are some other things that are helping it get to that 8 number, but it is a huge, huge number.
So it's a huge number that has to draw a lot of eyeballs. And like you said, we're about 40 days since the vote here. Have to imagine that more are coming.
Oh, for sure, for sure. The NFL is encouraging teams to get these deals done quick, in large part because it raises valuations. Some of these owners have succession issues, dealing with the state taxes. Some of them have stadium things, and some of them just want liquidity. Ross could be all of these. He's not short on cash. Maybe he wants to invest more in the Miami district, all of those properties that he owns. This money can be put towards helping that, developing the real estate around it, or just wanting more cash.
Yeah, or maybe diversify a little bit. When I saw the headline, it was the Ares name that got me. Seeing that and the Dolphins in the same headline made me click. What are the other PE companies or groups that we could imagine coming in, or do you have any said they are interested?
So there are 3 other groups that are approved. There's Arctos Partners and there's Sixth Street Partners, and then there's a consortium that is comprised of a company named Ludus, Dynasty Equity, Blackstone, Carlyle, and CVC. So it's a lot of money, and there's a lot of conversations going on between these groups and NFL teams. It's just a matter of time as far as when these deals get approved and when they're taken to the NFL for a vote.
And we don't have much time left, but talk to us about sort of the history of these specific assets, this specific deal, of course, with the Miami Dolphins. At one point, Ken Griffin was interested?
Yes, those talks fell apart earlier this year, but Ross continued to have conversations with a lot of different people, and eventually he landed on Ares. I think that there will be more deals. The Buffalo Bills are having a stadium, or excuse me, they have a 25% stake on the market right now. We've been told that the Eagles are exploring a similar stake sale, so it's only a matter of time. These things are going to happen pretty quickly. These owners want cash.
You love the Bills and the Eagles. You love cold weather teams, Katie.
I do.
I'm just saying, we have an internal chat, right? And Katie's like, I love the Bills. I love the Eagles.
I do.
I'd rather be in Miami. I would rather be in Miami.
I've tailgated at 2 Bills games, but both in New Jersey. I haven't actually been up in Buffalo.
Did you break a table?
Yes.
Nice.
Anyway, moving on.
Yeah, Randall, thanks so much for joining us. Hope to see you more on this show. Randall Williams covers sports for us at Bloomberg. Coming up in the next hour, we're going to talk to the CEO of Levi Strauss, Michelle Goss. She's going to talk about the retailer's drop in revenue guidance and the state of the consumer. But really, it's about the outlook that we're going to be asking her, because the shares, at least in the pre-market, I saw this morning, down 12%.
Oh, yeah, having a horrible day so far. Currently down about 8.5%. That was 11%, but that was only its worst drop since about June or so, only a couple of months. So a lot to discuss, of course, with the CEO of Levi Strauss. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience streaming live on YouTube as well. Alex Steele out today and tomorrow, but Bentley Lipschultz sitting in. That's a good and fine thing. So we got a lot going on in the marketplace. We have some ISM data coming out. Looks like it's better than expected. We're going to break that down with our first guest coming up in just moments. We're also going to check on Vince Signorella and get his thoughts on these markets. What are traders saying these days as we wait a big jobs data point tomorrow? Bobby Ghosh, Bloomberg News senior editor, who's going to give us the latest reporting coming out of Israel and the Mideast. Escalating tensions there, that is for sure. We're going to get the market call from Margie Patel, senior portfolio manager at Allspring Global Investments. So a lot coming up in the next hour, and we will bring it all for you here. Market's a little bit mixed here. Kick it off with Mr. John Tucker and a Bloomberg Business Flash.
All right, Paul, we are data dependent, so let's start right there. The Institute for Supply and Balance with the ISM Services Index, the biggest part of the economy, coming in better than expected, a reading of 54.9. Remember, anything over 50, that is expansionary. The expectation was for a reading of 51.7. Stocks, they are lower right now for the most part. The major averages, we'll call it mixed right now. More importantly, maybe the VIX, Wall Street's fear gauge, breath away from the important psychological level of 20. You have right now only 3 of the 11 major industry groups in the S&P 500 were higher. The biggest drag that was coming from materials, information technology, that's in the lead, and that's where you're going to find shares of NVIDIA. Those shares are up, but the CEO says the Blackwell chip demand, as he puts it, is insane. Right now, NVIDIA shares 4% higher. Tracy McMillan of Wells Fargo says after some volatility through the end of the year, stocks are the place to be for investors.
We do see upside potential for equities, so any pullbacks here related to these ongoing and emerging risks would be opportunities to position into equity markets.
Right now, the S&P 500, 3 points higher, 57.12 on the index. The Dow Jones Industrial Average, 154 points lower. That is down 0.4%. The NASDAQ 100 up 65 points. That's a rise of 0.3%. And Levi Strauss shares, they are slumping today, down 7.6%. Slumping after challenges abroad, declines in its home market in the U.S., and Dockers brand driving to cut its full-year guidance. And the CEO coming up in just about, 25 minutes or so, simulcast with Bloomberg Television. I'm John Tucker, and that is your Bloomberg Business Flash. Bailey Lipschultz and Paul. Hi, Bales.
JT, thank you so much. We appreciate that. Bailey Lipschultz sitting in for Alex Steele. She's out today and tomorrow, back on Monday. We'll be coming from Orlando. How about that? I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so check us out there and go Bloomberg Live Radio. That's what I did yesterday. That got me right to where I wanted to go, and that worked just fine here. Bailey, we got some ISM data came out today. Looks like better than expected here.
Looks better than expected. We see the S&P right now down, call it 2 points, but major averages, pairing losses, if not gains, looking at the 2-year right now at 3.7%. So see markets move.
All right, let's get the breakdown of the ISM data. Steve Miller joins us. He's the chairman for the Institute for Supply Management, joining us via that Zoom thing. So, Steve, seems like pretty good numbers. Again, 54.9 was the headline number. The consensus was 51.7, and the last period was 51.5. Pretty solid?
Yeah, very, very solid. We saw over a 6% increase in both the business activity and the new orders indexes, and that's really what drove the change in the PMI this month.
And Steve, when I'm looking at our Bloomberg headline, expanded in September at the fastest pace since February 2023, reading too much into that it's a bullish indicator?
So I'd say it's a bullish indicator because what we saw is an increase in kind of the broadening of the expansionary activity, both in business activity as well as new orders. But putting that in context, we're ending kind of a lackluster Q3. If you look at the average PMI for this Q3, it's really the lowest average since 2009. So although we're seeing, it was a great number for this month, but fingers crossed that with the port activity and such, we'll be able to see that continued growth.
Where would you like to see that headline number, that 54.9? Again, it seems pretty good relative to the last period and relative to consensus. Where would you like to see that?
Yeah, absolutely. So if we saw consistency, 53, 55 range, that'd be really healthy improvement. Coming off of a couple of 51s and then actually contraction before that, we're on the right trajectory. Hopefully we can hold it.
All right, very good. Steve, thanks so much for joining us for a few minutes there. Steve Miller, chairman for the Institute for Supply Management. That's ISM to us cool kids there, Bailey. Markets, S&P pretty much unched on the day. The Dow off about 160 point, NASDAQ up 75. So we got a little bit of red and green on the screen here. Let's check and see what the traders are saying out there in the world. Vince Signorella joins us, Bloomberg macro strategist. Vince, what are you hearing in the marketplace out there? We got some decent ISM data here today. Jobless claims kind of in line with expectations. What are you hearing today?
Actually a little bit of a surprise with the prices paid of that ISM number jumping considerably over the prior. Treasuries fading on that, as you might expect, with yields at session highs. But surprised actually that risk and equities is jumping on that. It's got to be pushing back on Fed expectations. So that's kind of the head scratcher today, in particular ahead of jobs data tomorrow, which could be very interesting. What I'm hearing from some private economists is they are expecting a much better jobs number in terms of a higher number. And with the whisper number from traders being lower, the expectations is with the potential for downside risk to especially the equity market tomorrow, and of course treasuries, if the jobs data comes in stronger than expected.
Yeah, Vince, as a former trader yourself, how would you be positioning with this data and ahead of jobs tomorrow?
I'd be fading this, to be honest. I like what I'm hearing from the private economists that they see jobs coming in higher for this number tomorrow. and we may see the downside coming basically in the following number because of hurricanes with the jobs data. But this one might be a little sharper than we'd like, and with the market leaning the other way. To me, the risk is that we see a little bit of a risk-off trade tomorrow.
It's interesting, just for the jobless claims number, the non-farm payroll for tomorrow, consensus 150,000. The whisper number had been in like 135. I'm looking at WHIS now. That's the whisper. It's now 146. So maybe off that ADP print, Vince, some of the consensus coming up a little bit, or the whisper number coming up. What else are you hearing out there in the marketplace? What else is moving markets? Because again, we do have the port strike. We've got Mideast tensions continuing to escalate there. What's kind of the narrative out there?
So the port strike is interesting because there's been an extremely higher imports coming in from the West Coast starting in May. So retailers were kind of expecting this to happen. I mean, there's absolutely no negotiation whatsoever between the union and the strikers, and I should say the ports. But you're beginning to see some panic among consumers, which may draw down resources or may draw down supplies, even though the supplies are there. So that could give us some shortages in the supply area. As far as other things, we heard this morning Biden said, or the White House said, they don't expect Israel to retaliate today. That's still something that's on the radar of traders, that it is inevitable that Israel is going to retaliate, and the expectation is it's going to be considerably more broad than it was the last time, not so much the proportionate response. So that's still hanging over traders' heads, and so I think we kind of jog in place a little bit until we see the jobs numbers and until we see what comes out of the Middle East.
All right, Vince, that's a great segue to our next guest. Vince Signorella, thanks so much for joining us. Vince Signorella is Bloomberg macro strategist. I want to welcome in Bobby Ghosh here. We really want to get some perspective on what's happening over there in the ever-fluid situation in the Middle East. Bobby Ghosh, he's the senior editor for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. Bobby, I guess where we are today is kind of waiting on a response from Israel, and boy, the optionality there for Israel seems really dramatic in terms of what types of targets they can hit, what types of targets they should hit. What's your view?
Well, Iran is a target-rich environment, right? It's a large country with lots of infrastructure, even though it has been under economic sanctions for a very long time. There's all this oil infrastructure. There's obviously military infrastructure. There's civilian infrastructure, power stations, bridges, and the such like. And finally, and this is the million-dollar question, there is the nuclear infrastructure. Iran, over a period of a couple of decades now, has been building a nuclear program. It is a distributed infrastructure. It's not all in one place. A lot of it is deep underground, inside mountains. Iran has anticipated attacks from its enemies, including Israel, and tried its best to conceal and to protect these infrastructure, these sites. And Israel has shown this in its recent strikes. In Lebanon, it has a lot of intelligence about where its enemies are, and it does have the capacity to cause damage, even to sort of enemies who are deep in hiding. So the potential for Israel is almost unlimited. And there will be a lot of temptation to hit those nuclear sites, because there is no question that if Iran were to develop a nuclear weapon, then Israel would be very, very high up, possibly number one on their list of targets. And it would change the security dynamics of the region. It would change the security posture of Israel. And so the temptation for Israel to go and do some damage, even if it is to put back the Iranian program by a year, 2 years, 3 years, I think Bibi Netanyahu would probably take that as a win. But of course, where we are now is what theorists call the escalation ladder. Each side is now almost locked into a tit-for-tat sort of situation where Iran felt compelled it had to do something. And so these strikes from a couple of days ago, Israel now feels it has to retaliate. Whatever the retaliation, Iran will then feel once again obliged. So we are now in the stage of this conflict where de-escalation is on nobody's minds except for people like us outside the country, people like like President Biden, are trying their best to get people to think about de-escalation. That's where, if you are in Tehran or you are in Jerusalem, that's not where your head is right now.
And Biden did say the U.S. would not back Israeli strikes on the Iranian nuclear sites. Bobby, you've spent decades covering this area, this region. How does this compare to previous conflicts, and what are you keeping a close eye on today and through the week?
Well, Billy, that's the thing. I've covered this conflict and conflicts in that region for decades, and even I frankly think we are deep in unknown territory here. We've never been here before in this exact place where Iran and Israel are essentially already at war. We can define war any which way we like, but one side has shot missiles into the other's territory, and the other is preparing to retaliate. That, by almost any definition, is war, and we've not been here before. Now, it's okay for the president of the United States to say we're not going to back Israel in a strike against Iranian nuclear targets. Israel doesn't need the United States' support to strike at those targets. What it needs is the U.S. to protect it from retribution. And the Biden administration has made it clear that we will do that. We will protect Israel from Iranian strikes. Just a couple of days ago, when those ballistic missiles were fired off from Iran in the direction of Israel, American warships in the Mediterranean, in the Gulf, were participating in protecting Israel from that. If Israel is guaranteed American protection, that frees its hand to take the offensive activities, the offensive actions that it feels necessary. The question is, in Bibi Netanyahu's head, in the head of the Israeli prime minister, what does he think is essential right now?
Does Bibi Netanyahu have the support of the Israeli people, broadly defined, for this expanded scope of war, as opposed to where we were almost a year ago, when it was simply, neutralize Hamas and get the hostages back? It's really expanded since there. Does he still have the support?
2 weeks ago, I'd have said no.
Okay.
There were lots of polls suggesting that the Israelis were wanted a way out of this fight in Gaza. Bibi Netanyahu was, even for a man who has been unpopular for a long spell of his career, his ratings were very, very low. But a lot has changed by taking out Hassan Nasrallah in Lebanon, and by not just taking out one leader, but taking out a whole echelon of Hezbollah leaders, and by sort of showing success on the battlefield. That has changed perceptions. We will see fresh polling in the days ahead. But my perception, just from speaking to friends in Israel, many of whom are not fans of Bibi Netanyahu, there's at least a quiet acknowledgement that his gambles so far have paid off. We shouldn't underestimate just how much of a boogeyman Hassan Nasrallah was for Israelis across the spectrum. Whether you were for Netanyahu or not, you grew up thinking of him as an existential enemy of the country. And the fact that he is now dead, and that the force that he represented, Hezbollah, is greatly degraded, that is a big, big win for Israel. And so that's given Bibi Netanyahu now, and now he has direct provocation from Iran.
Yep.
So that's given him the license and the excuse to retaliate in ways that he can be sure that a lot of Israelis will support.
And just to come back, again, Biden saying that Israel does have the right to respond proportionally. What will shift the U.S.'s involvement, if at all?
At this point, I can't see anything that shifts the American posture here. Proportionality is a fungible word. Who defines proportionality? If the Israelis were so minded, they could turn around and say, what was so proportionate about America's war in Afghanistan after the events of 9/11? These things can be thrown back at us any number of times over and over again. So proportionality means nothing in the context of war. There is a bipartisan support for Israel in the country. It's one of the very, very few things on which people on both sides of the political aisle in this country agree, that the United States has to back Israel no matter what. And as long as that consensus holds strong, and there's nothing to suggest it has weakened, as long as that consensus holds strong, it doesn't really materially matter who the president is and what they're saying about Israel.
Very good. Bobby, thank you so much for joining us. Always appreciate getting your thoughts, getting your perspective on that part of the world. Continues to be a fluid situation. Bobby Ghosh, he's the senior editor for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Just looking at these markets here on the back of the ISM data, kind of a mixed market here. The S&P is pretty much unchanged on the day. The Dow's off 100, but well off its lows. The NASDAQ is actually up 39 points or 0.2%. And we're looking at the yield curve. Yields are higher here. The 10-year Treasury, 3.82%. That's up about 4 basis points here, so a little bit of a lift to the yield. And we got about a 14 basis point steepening in the U.S. yield curve, 2s and 10s, about 14 basis points there. Commodity space, WTI crude oil up another 4% here, reflecting the geopolitical uncertainty in that part of the world. Now $73 a barrel for WTI crude. Gold, a little bit lower here, $2,650 for gold. We'll have more. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with his Bloomberg Business Flash. Had a bullish reading on the biggest part of the economy. Institute for Supply Management's Index of Services advancing to 54.9. Anything above 50 is expansion. Stocks erasing some of the earlier losses. The major averages there are mixed right now. S&P 500 down 3 points, 57.05 in the index. The Dow Jones Industrial Average 125 points lower. That's down 0.3%. And the NASDAQ 100 right now 4 points higher at 19,806. Crude oil extending gains as the prospect of escalating conflict damps risk appetite. Traders also waiting for any signs of the jobs report tomorrow, any signs of advance in the economy and the strength of the jobs market. And Tesla notifying U.S. auto safety officials of a 5th recall involving the Cybertruck in less than a year since the pickup launched. Carmaker deploying a software remedy last month to fix an issue causing the backup camera display to be delayed when drivers shift into reverse. Looking at Brent crude right now, the international benchmark that continues to power higher, up 3.9%, 76.80 a barrel. 2-year yields 2 basis points higher. That's at 367. The 10-year right now is up 3 basis points, and that's at 381. We check the markets for you right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate that. Bailey Lipschultz sitting in for Alex Steele here today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, so head over there and search Bloomberg Live Radio. That's what works for me. Coming up at the bottom of the hour, 10:30 Wall Street time AM, we'll do a simulcast with Bloomberg Television, including Michelle Gass, Levi Strauss, president and CEO. The company reported some numbers a little bit disappointing on the guidance. Stock down about 7.5%, 8% today. We'll bring you that at approximately 10:30. Right now, let's go to Margaret Patel, senior portfolio manager at Allspring Global Investments. Margaret, we're going to get a big jobs print tomorrow, which will be presumably pretty informative for this Federal Reserve. How are you thinking about the markets these days, given all the economic data that we have had over the past several weeks?
Well, I think it shows the economy is still growing. We had a great GDP number, 3%, which is better than I think a lot of people thought. And I think it says we're going to continue to move along at modest growth rates, probably less than 3% because some of the numbers, especially for labor, is mixed. So still positive, no recession, no boomy upswing in GDP. So a little more of the same, and a little pressure probably on revenues and profit margins going forward.
And Margie, now that we're have the first Fed cut in the rear view mirror, and at least the swaps market pricing in a string through the first half of next year, how are you positioning in this market, especially given the expectation that the Fed can navigate a soft landing?
Well, we think some things are out of control of the Fed, which is the economy, but we do think that we'll see another 2 quarter-point reductions in the Fed funds rate over the next few months, which would be modestly helpful over the longer term for the economy. But basically, we think that, as I said, the economy is growing. It's a sustainable level, but more modest than perhaps we might like to see. So we think that says that returns from equity will be maybe mid-single digit going forward, as opposed to the double-digit types of rates we've had so far this year. So no changes in the portfolio or outlook.
So, Margie, I'm looking at the INGO function of Bloomberg Index browser, and I see across the U.S. fixed income, everything's in the green here. Solid mid-single-digit returns for fixed income investors here. The highlight, though, is U.S. corporate high yield. How do you think about the high yield market? Is there any value left there?
Well, yes, there is. It's modest value, but actually ever since the Fed began to raise short rates a couple of years ago, the best performing part of the hub you get. So right now in BB bonds, you get a little over 200 basis points, 2 percentage points. For single B, say 3 percentage points. But with a backdrop of the economy growing and defaults looking like they're going to be under 2% over the next year, that says you're still getting a bargain for the risk that you're taking by being below investment grade. So we think it's still attractive, but modest. Certainly not, we're not looking for double-digit returns going forward, mid-single digits, just basically the coupon.
And so does that impact kind of your allocation to riskier debt, or how are you thinking about that?
Well, with yield spreads so narrow and dollar prices pretty high in the high yield market, most bonds are trading pretty close to their face value, maybe 98, 90 cents on the dollar. We think that you pretty much have gotten rid of the extra risk premium that was in the high yield market when the Fed had rates so high. So we don't think there's a lot of capital appreciation room. So really, if you're looking realistically, a return of, say, over the next year, 5, 6, maybe 7%. That says to me that the market really is going to favor stocks where I think we should at least get that much and maybe even a little bit more if we have growth stay around that 1-2% level. Basically, low volatility, modest coupon, and modest return is how we see fixed income in the high yield market right now.
And Margie, I guess just the month of September, it was a record month for new issuance. What is that? Is that good for the market?
Yeah. Yes, it's excellent because the problem with the high yield market is there simply has not been enough supply for all the demand by investors for that extra yield. In fact, we actually had about a year ago or so, the market actually shrink because we had new issuance drop off, we had maturities and bond calls. So the whole high yield market actually shrunk. So it would be very good to have a big supply. There's a lot of demand that will match that. And to have the high yield market grow a bit would add to liquidity, give investors more choices of names to buy. So I think more supply would be very positive. There's a saying, supply creates its own demand in the bond market. And we think that's...
Yeah, very good. Across all of fixed income, a really, really busy September for new issuance. Margie Patel, thanks so much for joining us. Margie Patel is a senior portfolio manager, Allspring Global Investment. She's based up there in Boston, joining us via Zoom. And coming up in just moments, we'll have the CEO of Levi Strauss, simulcast with Bloomberg Television. New issue market for equities. How are we looking here?
We're picking up.
Are we?
We had a couple big deals yesterday. Debut, Standard Aero sold $1.44 billion. We saw FrontView raise about $250 million. So we're seeing sponsors taking advantage of this pretty tight window ahead of the U.S. election.
Yeah, that's a good point. I mean, again, we've had, with S&P up 20% here. We've got rates coming down. That would seem to be a more constructive backdrop to get some of these deals out. And again, the private equity deals, the sponsor deals, there's got to be a huge backlog. I mean, I'm talking a year plus, I would think.
We've written about it close to $3.2 trillion is what some data said at the end of last year. So got to chip away at that.
All right, looking at the shares of Levi Strauss, off about 7.5% here. The company reported some numbers, a little bit weaker than expected in terms of the guidance. We have the CEO of Levi coming up right now, Michelle Gass. She's going to be with Bloomberg's Katie Greitfeld, Matt Miller, Shonali Bassick, talking about Levi Strauss and the future for that business. That's coming up. Let's take a listen right now. Levi Strauss, Michelle Gass.
And we welcome now our Bloomberg TV and radio audiences, and we're focusing on shares of Levi Strauss. Lower today in a big way after the denim maker narrowed its full-year revenue outlook. The company also revealing that it's exploring a sale of its Dockers brand. Joining us now, I am thrilled to say we have Michelle Gass. She is Levi Strauss president and CEO, and I think a lot of people were surprised by these results because fashion is fickle, but denim is back in a big way right now, of course, over leggings. You have this collaboration with Beyonce, the song came out as well, and yet, of course, you narrowed that revenue forecast. So how can you reassure investors that, of course, Levi Strauss is on that positive growth trajectory?
Yes, well, it's great to be here, and thanks for the question. What I would say is, first off, we're really confident in our long-term strategies for the business, and ultimately we see the business growing to about $10 billion in sales over time, and our strategies are working. I'm sure we'll talk about that, but let me set a little context for the quarter. Despite coming in at the low end of our guide, underneath that, there's a lot of strength in the business. I mean, clearly we beat our profit targets, our earnings were strong, and as it relates to revenue, overall we were up 3% on an adjusted basis. The Levi's brand was up 5%, yet we did have a couple areas that underperformed, namely our China business, Mexico, and also on Dockers. In terms of China, I would say that we have our own executional opportunities there. It's a big market. We see the long-term potential. We've changed out some leadership, and clearly issues have been exacerbated by the macro headwinds. In Mexico, we can isolate that issue to our wholesale business there, where one of our top customers had a cybersecurity breach, which impacted our ability to ship. We expect sequential improvement there as well. And then lastly, with Dockers, I mean, that's a brand that for us, it's underperformed for some time. We do believe that both Levi's and Dockers will ultimately benefit by being independent businesses. And for us, this is about focus and us focus and amplifying on the Levi's brand and also on Beyond Yoga, which we just acquired a couple years ago.
Well, I'm glad that you brought up Dockers because that's exactly where I want to go. Of course, you said that you're reviewing options for Dockers that could include a sale. You have the likes of Bloomberg Intelligence coming out and saying that if you did sell Dockers, it could free up resources to accelerate your direct-to-consumer expansion. But what options do you have if a sale doesn't happen? What else are you looking at for Dockers?
Yeah, I mean, as we shared yesterday, we are exploring strategic options, and our intention is to sell the brand to the right potential buyer. I'm actually quite confident in that, but we're all doing our homework around that. But to your question, this is all about distorting our resources against largely the Levi's brand. We see so much opportunity for that brand and for that business, and also accelerating Beyond Yoga, as I just mentioned. But as it relates to the Levi's brand, you know, today Levi's, we've been in business for 170 years, and we're really known and famous for the blue jean, of course, the 501. But we see an opportunity that's much greater in really evolving the brand to stand for head-to-toe denim lifestyle. And, you know, that's a big part of how we're seeing the momentum in our business. You know, we talk about the Levi's brand being up 5%. Well, that was driven by the strength of our direct-to-consumer business, both in our stores and e-commerce. DTC was up 12%, e-commerce up almost 20%. And we're seeing that across the world. And, you know, I'd say two things underneath that: real strength and opportunity in women's. Women's is about a third of our business today. That should be half, and we're well on the path. And then head to toe, whether that's denim dressing, denim lifestyle, and even tops to complement our bottoms. So there's just so much opportunity. So as we really focus on Levi's, like I said, we see accelerating into the future.
Michelle, I'm sure a lot of investors would love to see that continued investment, but one more on the Dockers sale here, because the faster you would be able to sell it, the faster you would have that money to reinvest.
Hey, ChatGPT.
Hello there. How's it going?
It's going really well. Today, I'd really like your help solving a math problem.
I'm all ears. What math problem can I help you tackle today?
So I'm going to write down a linear equation on a sheet of paper, and I'll show you. And then I'd love your help working me through it. But importantly, don't tell me the solution. Just help give me hints along the way.
Got it. Okay, I see it.
No, I didn't show you yet. Just give me help along the way. 1 second.
Whoops, I got too excited. I'm ready when you are.
So, ChatGPT, what equation did I write down there?
Ah, I see it now. You wrote down 3x plus 1 equals 4.
Yep, exactly. So what's the first step I should take to try to solve this?
The first step is to get all the terms with x on one side and the constants on the other side. So what do you think we should do with that plus 1?
Okay, I'm going to try to subtract 1 from both sides, and then I'll see what I get.
Great idea. Perfect. Now, what do you get when you subtract 1 from both sides?
Okay, so ChatGPT, this is what I ended up with. How does this look?
Spot on. Now you've isolated the term with x on one side, and it looks like 3x equal 3. What do you think we should do next to solve for x?
I'm not sure. Can you give me another hint?
Of course. You have 3x, and you want to find the value of x. Think about what operation would undo multiplication.
Is it subtraction?
Close, but think of the opposite of multiplication, because 3x means 3 times x.
Okay, I think it's division. Let me try to divide both sides by 3, and let me see what I get.
Bingo! Go ahead and divide both sides by 3.
Okay, so ChatGPT, this is what I ended up with. How does this look?
It looks perfect. You've solved it, and x equals 1. Nicely done. How do you feel about solving linear equations now?
Yeah, honestly, I'm not pretty confident I can solve linear equations, but why would you ever need to use this in the real world? I'm really skeptical.
That's a fair question. Linear equations pop up in a lot of everyday situations, even if we don't realize it. For example, calculating expenses, planning travel. cooking, and even in business for profit and loss calculations. It's basically a way to solve problems where you need to find an unknown value. Plus,
Wow,
it's
okay. You know, I have a lot of unknown values in my life. I'm totally convinced I'm going to learn math now.
I love that attitude. Math can definitely help solve some of life's mysteries. Whenever you're ready to dive into more math, I'm here for you. Anything else you'd like to tackle today?
So ChatGPT, I really love that you taught the value of math to my friend Mark. And I wrote one last thing I'd love if you could take a look at.
Of course. I'd love to see what you wrote. Show it to me whenever you're ready.
Okay, so this is what I wrote down. What do you see?
I see. I love ChatGPT. That's so sweet of you.
Yeah, well, I really appreciate all the help.
Had teamed up with Beyonce here in an exclusive ad campaign. Beyonce is queen. After all, she couldn't have come cheap. I'm wondering.
First, let me say, we are so honored to have this partnership with Beyonce. This comes after literally decades of having a relationship with her, dating back even to the 90s. And we've been a fan of Beyonce for a long time, and I believe she's been a fan of Levi's as well. And clearly earlier this year, we were so honored that she named a song after us on her new album, Levi's Jeans, and that sort of then led into a conversation of what was possible. And here we are just Monday launching this, what I would call breakthrough campaign. I mean, while we have worked with celebrities in the past and influencers and designers and the like, I mean, this partnership takes us to a whole new level. I mean, she is a global icon, right, across art and music and fashion. And it just made so much sense for us. I mean, Levi's, the brand, is at its best when we're at the center of culture. And there's nobody better than Beyonce to be our partner in that. And accelerating women's. I mean, over the next couple years, our plan is to really take that to the next level. So we expect, through Beyonce, all that she means, and candidly, the reach she has. I mean, she's got hundreds of millions of followers. Like I said, that this is going to be a great partnership for the business.
Can I ask you, just for the overall picture on labor, what your employee headcount looks like and which direction it's going? I mean, are you looking to add employees for more production? Do you need to shut down in order to right size? What are your plans in terms of your workers?
Yeah, so around the world, Ellis & Co., we have about 20,000 employees. Great. I mean, we have a phenomenal culture. I am inspired every day, whether I'm working with the team here or out in the field working with our teams in our stores and our distribution centers. And as I said earlier, our intent is to grow this business. We're $6 billion today, a little more than that, taking that to $10 billion. And over time, we will be hiring more great Levi's employees to bring phenomenal experiences to our fans all over the world. I mean, a big part of our growth strategy is around direct-to-consumer and building more stores across many markets. So for us, it's about growth and it's about profitable growth. And like I said, we look forward to welcoming many new employees into Levi's over time.
Michelle, thanks so much. Michelle Goss there of Levi Strauss talking to us about their quarter and their outlook as well. All right, that was Levi Strauss, President and CEO, Michelle Goss, sitting down chatting with Bloomberg anchors Katie Greifeld, Matt Miller, and Shonali Bassick. Full disclosure, I am a Levi's wearer. That's my brand.
Are you a
John
Dockers
Tucker?
wearer?
No, please. John Tucker is also, we've learned that he is a Levi's Strauss guy.
Okay.
And you?
Well, it's not like any fashion plate.
Oh, John,
I wouldn't be taking your fashion direction
There's a
for
certain
me.
demo that follows John, no question. How about you, Bailey?
I'm in the millennial bucket that does not really wear jeans. So I will dabble in a Levi's chino, but like for the most part, I'm not loyal to a particular brand.
I really don't care what Bailey's wearing.
I think about
I'm sorry.
our listenership, our viewership, I'm sure they're hanging on it, every word there.
Certainly not Dockers. That's all I will say.
Yeah, I think they're, from what you hear, they're getting...
I want any pants that can expand with my waist. That's where I am right now, Paul.
All right. With our Bloomberg Business Flash, here is Mr. John Tucker.
All right, expanding in the markets, to the markets, S&P 500 right now contracting, down 15 points, down 0.3%, 56.94 on the index. The Dow Jones Industrial Average down 228 points. That's a decline of 0.5%. NASDAQ Composite Index is 40 points lower. That is down 0.2%. Weighing a couple of things, we had a positive reading on services. Then you have the prospect of the escalating conflict in the Middle East. Crude oil and the dollar extending their gains. Traders also waiting for tomorrow's jobs report for clues on the future direction of monetary policy. Most active stock right now, NVIDIA Corporation. CEO says the demand for the Blackwell chip is going to be insane. Right now, NVIDIA shares, one of the holdouts, that's up 2.5% right now, 121.93. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and we are being brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your terms with a partner dedicated to your success. Go to commonwealth.com to learn how. We check the markets for you all day long, as I say, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Bailey, Paul.
All right, John Tucker, thank you so much. Bailey Lipschultz sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over to youtube.com, search Bloomberg Live Radio, and that's where you will find us. We just heard from the CEO of Levi Strauss, Michelle Goss, talking about the business. Let's do a little bit more retail here. Mary Ross Gilbert, she's a senior equity analyst for Bloomberg Intelligence, covering the retail space. She's based out there in Los Angeles. Mary, what did you make of, we'll just start with the Levi's story. What did you make of their quarter, their outlook, and kind of maybe some of the reasoning for some of the weakness they're seeing?
Yeah, so Paul, with the Levi's earnings out yesterday, I think there was too much focus on some of the negativity. So, for example, weakness in China. China's only 2% of the business. And still, the growth prospects there are tremendous. But we have been hearing that there has been some weakness generally with the consumer. But also, I think there's some execution opportunities there. So they did bring in a new leader. So I think we could see things shift. But frankly, it's really, really small. If you look at what's happening in the bigger parts of the business, the overall Levi's business on a currency neutral basis was up. And if you look at direct to consumer, and that's about 44% of the business, that was up 12%. The US DTC was up 12%, Europe was up 9%, and also the European wholesale business turned positive and comped up 4%, and then they have a strong order book for the fourth quarter. US wholesale, though, is still, trending negative. It's improving, but still negative. So you do have a little bit of headwinds there. But like I said, the big focus is really on DTC. It's on women's. The women's business is about 35% of sales, but that could be half the business. That was also up double digits with strong performance, across bottoms and tops there. So I think there's some real strong points here. And then the news about the sale of Dockers, that's great news. They've tried to sell this company in the years past, and it will be great to get rid of it and really focus on the strength of the Levi's brand and also expanding beyond yoga.
Mary, you sound really bullish and the stock's down 8%. So why is it getting beat so badly? I mean, it's returned over the last 12 months 51%. Is it sell the news, or is it just that uncertainty from a macro perspective?
I don't think so. I think sometimes there's volatility around earnings that don't necessarily reflect the true fundamentals. So I think there was a miss on the top line, on the revenue miss versus consensus. But of course, they beat on the bottom line. But I think the real focus was, okay, they said net revenues. Previously, the guidance was net revenues to rise 1% to 3%. Now it's going to be just up 1%. I don't really, if anything, I view that as an opportunity to beat. We do have the port strike, of course, that's making headlines, but Levi's and a lot of other apparel companies have shifted more of their shipments over to the West Coast. And when you think about holiday, most of that is already in. They start shipping in July, or the West Coast ports start receiving in July, and it goes all the way through September. And September was quite busy for the West Coast ports. I checked in with the Port of Los Angeles yesterday on that. So I I think there's going to be some impact. Obviously, it really has to do with how long the strike lasts. But I think that Levi's, Macy's, and other companies have mitigation measures in place.
What does it mean as it relates to the port outage here on margins? I mean, presumably their cost will be higher to get some product that was East Coast bound to get it now to the West Coast. What does that do to their margins? Have companies given any guidance?
Yeah, there's a couple of companies that have indicated, not all of them. So, for example, Oxford Industries, so that's the Tommy Bahama, Lilly Pulitzer brands. So what they did say is that they expect a negative freight impact in the second half of about 15 to 20 basis points. And in that, they did incorporate what they think might be the impact from a possible, because again, their earnings call was before the strike, which just hit this week on Tuesday. They said that that does incorporate that impact, but once again, it depends on the duration. And just looking back in previous disruptions with regard to the port, we sort of estimate it could be in that sort of 10 to 20 basis points impact on margin. But again, it depends on the duration and then also any other mitigation factors that will help offset some of those costs if they're able to.
And Mary, you mentioned the duration. How long does this strike have to last for it to start to show up and impact some of these businesses?
That is a really good question. When I think about some of the other disruptions and the duration, and of course the last one that happened back in the 70s, that was 60 days, and I can imagine the damage must have been pretty extensive. And even just thinking of, let's say 8 days, going back to 2015 when the West Coast ports had some, shutdowns. So it wasn't actually a strike, but they were called shutdowns at that time. And that did last for days, but there was an impact that lasted months after that. So there was an impact on margin because if you have a delay in getting your apparel, then once it does arrive, you have to promptly mark it down. And that's exactly what happened with Macy's. On off-price, they tend to be less impacted to a certain extent because they can just pack it away and bring it out, when the season is right.
All right, Mary, thank you so much for joining us. Mary Ross Gilbert, she's a senior equity analyst covering the retail space for Bloomberg Intelligence. She's based out in Bloomberg's Los Angeles office, joining us via that Zoom thing. So again, Levi Strauss, interesting hearing the interview with Bloomberg Television from the CEO. They're still saying pretty optimistic about overall demand out there and able to manage prices, and felt like some of the weakness there might have been a little bit short term in a couple of local markets there. S&P 500, we're off about 12 points here today. The Dow's off about 200, and then Nasdaq's off about 25 points. That's 0.1%. The yields are a little bit higher here across the curve. Let's take a look at the 10-year Treasury, up 5 basis points, 3.83% on your 10-year Treasury. WTI crude oil up 4.2%. We're now at $73 a barrel for WTI crude. Definite impact there from the Mideast risk. This is Bloomberg.
Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, that port strike, it is still there. We're day 3 here, and it's starting to get serious here. And you don't get a sense that there is, a lot of discussion going on here. So the question is, when is it going to really start to impact this economy and to what degree? Jessica Kriegel joins us. She's the chief scientist at Workplace Culture. The company is called Culture Partners, joining us via Sacramento, via that Zoom thing. Jessica, talk about this strike. How do you kind of envision this strike from both sides' perspective? What's going on here, and where could there be movement maybe?
Well, this strike comes down to ultimately 2 issues. It's about wages and it's about automation. So Harold Daggett, who's the president of the ILA, has said not only are they wanting a 77% increase, which is significant, they've already been offered 50%, they're going to 77, but they also want to create airtight language, quote unquote, airtight language that removes the ability for the ports to use automation or semi-automation. And it's downright archaic what they're asking for. If you want to understand what kind of automation they're saying they refuse to allow, it's not some complicated new fancy AI technology. We're just talking parking gates going up and down. They're not okay with that kind of automation. They're not okay with time card stamping automation. In fact, right now they have people who are employed as schedulers to write down who is there when they arrived and when they left, which allows for inaccuracy in time reporting. So they're really holding the port hostage with these demands, and that is why we're at a standstill. I think we could easily get there at the wages. The ports are doing very well. They have the financial capacity to meet the needs of 77%, but it's really the automation that is the sticking point.
Is that just a fear of automation becoming a slippery slope from your understanding?
I don't think it's a fear. I think it's a strategy. They have said, quote, "I will cripple you," are words that have come from the president of the union's mouth. He is intentionally trying to cripple the American economy in an effort to get what they want and to maintain the job security. And it is downright un-American. I mean, I believe that every industry has the ability to implement basic technology, basic automations in order to advance and progress as a society. And what's interesting here is if you look at what they're doing, they're actually making the argument for why we need these ports to implement automation, because if they were automated, we wouldn't be being held hostage by this union. And the effects of the economy and the American consumer are going to be felt soon. And it is going to be widespread. There will be panic. There already is panic. There's already been a run on toilet paper and paper towels, which is completely unrelated to the imports from these ports. So it's interesting. That's really just psychological in nature. We're remembering when toilet paper wasn't available at COVID, and so people are going to stockpile toilet paper now. But what else will they stockpile? And who else is going to be affected by this and lose their jobs because supplies that they need to do their jobs haven't arrived? It's really going to be devastating if this doesn't get resolved soon.
So, Jessica, has anyone on either side quantified the potential job loss from automation? How big of an issue is this in reality? Do we know?
There are a lot of analysts making estimates on the cost that this strike will have, and the ranges are significantly wide. So it's unclear. And the job costs, we can only speak right now philosophically. As construction materials don't arrive, then construction workers are not going to be able to do their jobs. And so they will be laid off or temporarily furloughed. And that impact will be devastating on those workers. So if you think about the union workers are being very selfish right now, and they do want the American worker and consumer to feel the pain. They're counting on it. They're looking forward to that. And I think one of the devastating things here is that they're saying, and don't blame us, blame them. So they're not taking accountability for the strategy. And I also don't think it's very logical, because the American worker and consumer is going to become outraged and say, you know what? Screw that. We want them to automate, because this is a danger to the American culture, society, workplace, labor market, all of it.
But Jessica, in terms of the actual dock workers, about 25,000 at the East Coast and Gulf Coast ports, what percentage or number of those workers would be at risk of losing their jobs if automation were to be implemented at a grand scale?
It all depends on what we're talking about with regards to automation. So the schedulers will lose their job if we implement time cards. Right now, there is already some automation. If you think about it, I was listening to an interview with one of the union strikers yesterday, and he said, you know, decades ago, we were literally offloading 125 pounds of sugar with our hands. So that's not happening anymore. That's because of automation, and I'm sure that they celebrate it. So the where automation is allowed and where automation isn't allowed is exactly what's under negotiation. There is already in their current contract language that prevents new automation. They're not saying that they're okay with that language, though. They're wanting to go backwards. They're wanting to remove automation that's already been implemented. And so that's really regressive and not progressive at all.
All right, we'll have to see how this plays out. We're day 3, and again, the tensions are mounting, the risks are mounting for the economy. Jessica Kriegel, thank you so much for joining us. We really appreciate getting your thoughts and perspective. Jessica Kriegel, she's the chief scientist of workplace culture. The firm is called Culture Partners. They're based in Sacramento, California, and she's joining us via Zoom. I tell you, the story today here is just these move here in oil. We've got WTI crude oil up 3.9%, Brent crude up 3.5%. Some big moves on account of double-digit moves just over the past several days. So President Biden making some comments that, you know, talking about the potential risk of bombing some of the energy infrastructure in Iran.
Yeah, and as you know, Paul, I'm a big stocks watcher. That's what I do in my day job. Energy top performer in the S&P 500. And if you strip out the rally, to your point, that we're seeing in the energy space, and also the fact that NVIDIA is up 3%, adding 10 points to the S&P 500, we would probably be looking at a sharper sell-off instead of it being, you know, 0.4% for the S&P 500.
All right, coming up in the next hour, we're going to get some additional reporting there. Devika Krishna Kumar, Bloomberg oil markets reporter. She's going to join us on the move here we're seeing in crude oil. Global crude oil higher on war concerns. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, again, we're going to get the latest reporting on the global oil markets. Oil is moving higher on concerns of escalating tensions in the Middle East. Devika Krishna Kumar, she covers the oil markets for Bloomberg News. She's going to join us here. We appreciate that. Coming up, Anurag Rana, Bloomberg Intelligence technology analyst. OpenAI, they raised $6.6 billion yesterday. Some real investors, some A-list investors in there. And that gives that company a valuation of $157 billion. So just extraordinary numbers. We'll break that down. Frances Stacy, chairwoman of the Global Digital Finance Committee, on her outlook for the markets. We got a lot coming up here in this hour. Right now, let's kick it all off with Mr. John Tucker.
All right, Paul, the major stock averages in Bailey, they're lower. Only 3 of the 11 major industry groups in the S&P 500 are actually higher right now. And Bailey, as you mentioned, energy best performer in the S&P 500. As oil continues its climb, President Biden asked if he would support Israel striking Iran's oil facilities, responded, quote, "We're discussing that." So throw that into the mix. Brent, the international benchmark, 76.63 a barrel. That is up 3.7%. Consumer discretionary, the biggest drag in the S&P 500. That's where you're going to find shares of Tesla. Tesla shares right now down close to 2%. The economic data today, services sector expanding at the fastest pace since February of 2023. So that news did briefly help stocks erase some of the losses. Matt Mishkin at John Hancock says Fed Chair Jerome Powell won't be able to deliver another jumbo rate cut.
He's likely going to have to pull back on the dovish tone. To us, that's going to mean the market's not going to be as happy about this, and we're probably going to continue to see chop. The last time, in 1997, we had 3 great quarters like this. October was a tough month, so we actually expect some volatility here near term.
Yeah, shares of NVIDIA among the most actively traded. They're up just about 3% right now. By the way, NVIDIA insiders cashed in on shares worth more than $1.8 billion so far this year, and more selling is on the horizon. S&P 500, 22 points lower. That's down 0.4%, 56.87 on the index. The Dow Jones Industrial Average is down 289 points. The NASDAQ 100, 49 points lower, and that is down just about 0.25%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate that. Bailey Lipschultz sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live video on YouTube. So head over to youtube.com, search Bloomberg Live Radio, and that's where you will find us here. As John Tucker is just reporting, we got red on the screen here, and again, calling out the movement in crude oil up about 4% for WTI crude oil, $73 a barrel. We're going to have some further reporting on that in just a moment. Let's see what's happening underneath the hood with these equity markets with Nora Melinda. She covers the equity markets for Bloomberg News. Nora, what are you looking at?
Well, I'm keeping an eye on some of the apparel names here, Paul and Bailey. We're looking at Levi, and this is Levi Strauss's ticker LEVI. We're seeing shares down for their biggest drop since June, tumbling as much as 12%. And this is after the company tempered its annual sales forecast. It was really talking about the Dockers brand. Honestly, I had to look it up, but apparently it's like khakis. Is it men's khakis?
For old men.
Oh, they're expansive. They stretch.
Yeah, I mean, they have the special, elastic fabric.
I had a pair of Dockers in high school.
I was going to
for
ask.
Golf. But that was that was the extent of my Dockers.
Very on brand, right? For the khakis, but apparently
I love
that
them, by the
segment,
way.
you love it.
Oh, yeah, no, they're great. It's like, they're very comfortable.
You're their biggest customer.
What are you saying?
Well, that part of the business is not doing as well, apparently. They're actually exploring a potential sale for that brand. But the company is also pointing toward weakness in China as part of the reason that it did have to pare back its full year sales outlook. But when I'm looking on a broader scope, we do have shares up about 17% year to date.
Yeah, Mary Ross Gilbert actually had been, Bloomberg intelligence analyst talking to us about the company, had been saying that they've been a couple years of chatter around what they could do with Deckers. So for their sake, hopefully going to get it off the company's hands. Nora, the big driver, though, today, NVIDIA. What's going on?
As always. But today we're looking at NVIDIA because the CEO said in conversation with CNBC that demand for Blackwell chips is, quote, insane. And of course, that has been driving the stock. We're seeing shares of NVIDIA up as much as 4.6% in trading today. And apparently this is kind of quelling concerns about Blackwell and the engineering snags that investors were really worried about here. So this is really great for the stock. Of course, we know NVIDIA is just a giant that's been doing so well, up at almost 150% this year.
What is Hims and Hers? What is that company?
What? See, this is where I get to come in.
The divide of the
generational divide here.
She doesn't know what Dockers is. He doesn't know what Hims and Hers is.
And this is where we land. So that's ticker HIMS, HIMS. This is a telehealth platform. It's really focused on getting the convenience aspect, so you can get online medications just going online instead of going in store. And I see commercials all the time. Do you, Bailey?
They made their money on things for hair loss and ED and stuff like that.
Okay.
Yeah.
So, but is this the real patented Viagra, or is it the knockoff stuff? And
That's a good question.
Same for the.
I mean, I've heard it's legit. That's all I know, is that the stuff does work and you can get it online. But that's interesting to know.
All right.
It depends, I think, Paul, from my experience covering the company, is that the generic drugs for hair loss or Viagra is what you would get from a CVS, but they're actually under some pressure because they would get the off-brand version of Ozempic or Wegovy.
There you go.
They benefited from at one point in time.
But is the off-brand, is that as effective and the same thing or not?
Within weight loss, it's compounded. It's kind of like tangential. No one, I think, from my understanding, is 100% sure if it's the exact underlying molecule.
Lovely. Well, I mean, you did mention the weight loss aspect, and they were really operating on the fact that there was a shortage when people were looking for Ozempic and a lot of other weight loss drugs. But now that shortage is getting better, they are tumbling after that, especially as they said that the shortage has ended. But I will say, this is a newer company. They were founded back in November of 2017 and went public in 2021. So, maybe there is a reason that you guys weren't as familiar.
All right, very good.
Just get the expanding Dockers, and you won't have to use the drug.
Yeah, absolutely.
There you go.
Expanding Dockers. There you go. I appreciate that. Norma Linda giving us the update on the markets. Again, we've been calling out crude oil. Brent crude oil up 3.9% today, $76.77. Big move higher over the last several days due to the Mideast tensions here. Devika Krishna Kumar joins us. She's a Bloomberg Oil Markets reporter. Devika, thanks so much for joining us. What's the latest that's moving markets today?
Hi, thanks for having me. Today, the big question now is whether Israel's retort to Iran's missile strikes will involve oil targets or not. We just had moments ago comments from President Biden saying that that's currently being discussed. Now, the market's obviously on edge because oil infrastructure is critical when it comes to determining supply and demand going forward. Iran produces over 3 million barrels a day, so any attack on their main export facilities or energy infrastructure could have significant ripple effects across the market, which is why we're seeing now prices rise for a third straight day because markets are very much on edge about how this is going to play out.
And just looking at your reporting, you cite a Citigroup analyst saying that a major strike could take 1.5 million barrels of daily supply off the market, whereas a minor infrastructure strike on downstream assets would be closer to 300,000 to 450,000 barrels a day of output. Can you just put that into context and what that means for the energy space and for oil?
Yeah, of course. We are actually in an interesting market right now because some people like to call it an artificial prop-up because OPEC members and allies are basically curtailing production. They were supposed to return supplies to the market in October, but they took a look at the market and how demand was looking kind of shaky because of questions about economic growth in the US and China, the two biggest economies in the world. And they thought, well, maybe we should pause and maybe we should kind of rethink returning supplies to the market. So now the current plan is to return supplies to the market in December. So when the market looks at this broadly, the reason we're not actually seeing more talk about $100 oil or an insane spike in prices is because the market is aware that OPEC members like Saudi Arabia, UAE, other Middle Eastern producers could quickly bring on supplies should we face a major shortage. And obviously, there's also the sense that we need to understand how demand's going to play out. There's still worries about the economy, both in the U.S. and China. And bear in mind, China is actually a big buyer of Iranian crude. So even if we had, even if this doesn't descend into further missile strikes and an all-out war, we might see tighter economic sanctions. And that's kind of interesting to see. It'll be interesting to see how that plays out as well, because you could only target financial components of that trade, and that may not necessarily result in loss of supply. So in the broad context of things, there are several moving parts here, and the market really needs to understand how each component is going to play out, and it's happening real time, which is why we're seeing the volatility in prices.
Devika, thank you so much for your reporting. Really appreciate getting a few minutes of your time. Devika Krishna Kumar, she is part of the team that covers global crude oil for Bloomberg News, and they have a good reporting out this morning, so check it out on the Bloomberg terminal and on Bloomberg.com. Another big news in the tech space is some of the valuations, they are coming back, it seems like, in a big way, particularly if you have anything to do with AI. So if you have a company that's called OpenAI, that's a pretty good name to have and a pretty good time to raise capital. OpenAI just raised $6.6 billion in the private markets of new funding, giving the artificial intelligence company a $157 billion valuation as they look to build the world's leading generative AI technology. Let's check in with somebody who knows this stuff really well, Anurag Rana, technology analyst for Bloomberg Intelligence from the Tech Hub of Chicago, Illinois. Anurag, talk to us about OpenAI here. These are some real numbers here, Anurag, and there's some real investors investing in this company at this stage. What do we know?
Yeah, OpenAI has really taken a lead over the last 3 years because of the launch of ChatGPT, and after that, it has become the go-to things even for enterprises. We recently did a CIO survey, and OpenAI Microsoft combination was far ahead than all the other large language models that was out there. So that's on the enterprise side. And consumer side, we already know how well they are doing, both on the app that they're selling, along with the distribution that what they won with Apple being part of Siri when the software upgrade is going to come. So OpenAI in the world of large language models, really at the top of the top of the mountain at this point, and this is one of the reasons you're getting these high valuations.
Yeah, I just want to put into perspective. At $157 billion, OpenAI would be larger than Uber, and at that $6.6 billion in funding relative to IPOs, it would be the 12th largest global IPO since 2018. So, Anurag, are we in a AI bubble as it relates to private markets?
I think, to be very frank with you, I can only answer that 5 years from now. But we just, updated our numbers looking at capital expenditures for the top 5-6 companies. These companies, which includes Amazon, Microsoft, Meta, Oracle, etc., in 2023, they spent about $110 billion in all the things what we call capital expenditures. In 2025, they're going to spend about $200 billion. So that's a massive increase of $90 billion over a 2-year period. Where is that money going to? Expansion of data center, buying more GPUs, buying more hardware, expanding their own large language models. So it really feels real, frankly, as to the amount of money that the big guys are spending over here. And they won't be doing it if they didn't see the demand on the other side of the equation.
This has been a turbulent year for the company here. I know last November, the company's board fired and then quickly rehired the CEO, Sam Altman. Following months, they had a lot of key leaders leave, including the co-founder, the chief technology officer. It seems like the market's kind of forgotten all about that, or maybe it's not a problem anymore. How's the market dealing with some of that turmoil we've seen over the last year?
I think people tend to forget that who's really behind a lot of backing of this particular company, and that's Microsoft. And they have the biggest distribution among enterprises. So if they are basically telling people, if you want to create an enterprise application using some AI large language model, here is OpenAI model, and you can host it on our cloud platform. I think that is resonating very well with customers. So as long as that continues for the next several years, OpenAI's revenue will continue to go up. And, then you can, argue whether the valuations is high or not.
And just from the Bloomberg reporting, Tiger Global put in $350 million, Altimeter putting in at least $250 million. But to your point, if Microsoft is able to write such large checks, how does that impact the funding environment for AI companies? I'm just thinking about the biggest competitors for OpenAI in Anthropic and xAI.
Yeah, I mean, Anthropic is backed by, Amazon Web Services at this point primarily, and almost all the others. The one thing we heard, from reporting from Bloomberg News is that OpenAI is asking them not to back up, Elon's xAI or others. And I think that's partially the reason you see all the other plays coming in, because and by the way, there's not going to be one winner. There are going to be multiple models. There are going to be multiple companies doing well here. And there is no reason Anthropic can't thrive in this way, or Mistral, or all the other large language model companies.
What do we know about OpenAI's financials, if anything?
I mean, I don't have a clear picture on it. I've read as much as you have, and we have seen projections out there for the next several years. They can get to, I don't know, 5 billion, 10 billion, or so forth. So I mean, it's unless we see the S1 when they go public, up till at that point, it's purely a guesswork.
Do we have any sense of? Do they have an appetite to go public? Is it a sense of timing? What are their plans for going public, if any?
See, my personal view is they don't need to go public at all. Yeah. They don't need the funding. They will, the whoever is part of this particular ecosystem is getting rich every day. I think they should figure out how to grab as much enterprise workloads as possible before they think about it. Because one thing is for sure, even as they are doing this land grabbing right now, they're at a loss, and they will be at a loss for several years out, because the cost of running these workloads is very high, and it's going to, you're not going to see any free cash flow, you're not going to see any, but once you go public, you really go under the lens about profitability and your margins.
We only have about 30 seconds, but going back to a story that has been reported out recently in terms of giving Altman a stake in the company that could be worth more than $10 billion. What do you make of those conversations and what that could mean for the company and its ambitions?
Yeah, I mean, he's always talked about how he's doing it for the greater good of the world, but I guess when you get this much options, you change your mind on that end. But maybe it is what it is.
It is what it is. We always fall back on that one. I love it. Anurag Rana, technology analyst, Bloomberg Intelligence, joining us today. Talking about OpenAI, again, just a huge funding round, $6.6 billion raised, and giving the company an evaluation of $157 billion. That's just massive and impressive in and of itself. What's also impressive to me is who's going in there. We're getting some big technology companies, including NVIDIA, some seriously smart private equity money, private capital money, including Tiger and some others, and Fidelity as well. So what a lot of folks would call smart money getting in, even at this valuation level. That gets your attention here. So we'll keep an eye on that. S&P 500 off 15 points. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This is Bloomberg Business Flash. We're brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast. Get started today. Major stock averages right now, they're lower. Only 3 of the 11 major industry groups in the S&P 500 are even higher. Energy, the best performer as oil continues its climb. Consumer discretionary, that's the biggest drag. That's where you're going to find shares of Tesla. The economic data today, including the services sector, expanding at the fastest pace since February of 2023. And as we look at some of the most actively traded in today's session right now, NVIDIA, it is up 3% right now. NVIDIA shares, they are higher after the CEO said the demand for the new Blackwell chip is pretty amazing right now. President Biden was asked at the White House if he would support Israel striking Iran's oil facilities. He responded saying, quote, "We're discussing that." As we look at crude oil, Brent, the international benchmark, that's up 3.8%, 76.78 a barrel. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate that. Bailey Lipschultz sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio with John Tucker. We're also streaming live on YouTube.com, so you can find us over there. Just search Bloomberg Live Radio. You know, we're a little bit of a sell-off here today. A lot of just kind of mixed trading here, all within 1 or 2% of the all-time highs. I mean, why not? I mean, I guess you got a Fed cutting rates. You got decent earnings. I guess that's a pretty constructive look for this market. I wonder how the technicals look. Our next guest, I think, can help us a little bit there. Frances Stacy, chairwoman of the Global Digital Finance Committee, joining us from Tampa, Florida via Zoom. Frances, again, you look at this chart, it's kind of up and to the right here. What do the technicals tell you about this market? Anything concerning you?
Yeah, so it's very interesting because the technicals actually look quite toppy. And I do think that if the S&P gains any kind of momentum and a bit of a sell-off, which is, you know, could be news driven. We've got a big jobs number coming out tomorrow. You know, I think 56.25 is the initial stop for support to indicate that the upward trend is well in play and there's nothing that's coming on the horizon as far as calculating in additional risk. I agree with you. The Fed is obviously changed its modality into an easing mode, and that's happening globally. I mean, the global money supply is up 7.3 trillion as of September. And just globally, we're getting a lot of simultaneous rate cutting, and that supports the reacceleration in global growth type mindset. I do think we'll see a little bit more softening in the growth and labor markets here in the U.S. And we just have to see if there's a catalyst that would indicate a recession.
Well, how much is that recession risk being priced in? I'm just looking at the swaps market, and at least as it relates to the Fed, we're at an implied rate at around 3.5% by May of next year. NVIDIA is kind of the S&P 1, if you will, and is seemingly talking up demand. Apple and Microsoft are relatively bullish as well. Kind of what do you make of those dynamics?
Yeah, so absolutely there's no indication, and the markets are not pricing in an indication of a recession, which makes this rate cutting and aggressive rate cutting, I would argue, globally very interesting. I mean, I think they're cutting rates globally on the orders of magnitude that they did during the, you know, the global financial crisis without that catalyst in place. It's just basically looking at the yield curve and potential, you know, what happens when you have a prolonged yield curve inversion that is, you know, pretty severe, and you have the re-steepening. Quintessentially, that has been an indicator mechanically of an imminent recession. However, there was always a catalyst. You know, in the 90s, you had the invasion, you know, the Kuwait situation. In the 2000s, you had the tech bubble bursting. And then, of course, with the GFC, you had the housing bubble burst that sort of tipped that domino effect. Right now, there's nothing in the system, and certainly, as you say, not being priced in, that domino effect is ready to be tipped. But, you know, sometimes these things happen slowly and then all at once.
So overall, I mean, here, it seems like, again, the backdrop for a lot of the bull seems pretty simple. I've got decent earnings growth. I got interest rates coming down. Is the recession risk something that could really be upset that kind of foundation?
Yes, certainly if there's a catalyst, and we do have some potential catalysts in our geopolitical environment. I don't know sort of what volatility the election outcome could enter into the system. So we just, you know, we just have to watch the catalyst. We have to, as you say, you know, watch the spreads, watch the swaps, and see if there's any sort of a reaction there. It's interesting because from the role of my new committee, and I've brought in John D'Agostino, who's very storied, as my co-chair. We are looking at the fiscal and debt dynamics around the world, and we are engaging countries and looking at the new prominence of global digital finance and what that algorithm looks like. Because here's the thing, you put a record amount of monetary and fiscal stimulus in, you know, pretty much globally, but the most in the US during COVID. And then, you know, something like the mechanical implications of the yield curve inversion, we've seen an elongation of the seasons of these economic cycles. And so the question becomes, have the mechanics fundamentally changed post-COVID, or do we have the same mechanics in place on a delay? And then also just looking at the liquidity dynamics around the world juxtaposed to the debt, and looking at a potential new algorithm for the managing of this, the managing of recession risk, with the integration of the digital finance component, and certainly, a potential for digital currencies as well.
So are you talking, we talking Bitcoin? Is that what you're kind of alluding to?
Bitcoin will never replace fiat because it has a finite supply, and it cannot disrupt the function of the central banks if it cannot do the function of the central banks. Central banks adjust money supply, and in the United States they have their dual mandate of price stability and full employment. They could never accomplish that because they can't manage the supply of Bitcoin. But for instance, El Salvador has this hybrid approach between Bitcoin and the US dollar. And I do think that it's kind of like trying to make an electric car talk to an internal combustion engine. They have different underlying mechanics, but there is potentially an algorithm possible that bridges that gap and brings in a digital currency. I do think if we see digital currencies, obviously Bitcoin is legal tender in El Salvador, but if we do see digital currencies widely adopted as legal tender, it's going to be the central banking digital currencies, because those are the only things that can disrupt what the central bank is doing. The central bank has been given all of the legal authority, has all of the legal precedent from Congress. And, you're not likely to unlock that anytime soon. So I do think that there's going to be an opportunity coming up, but that's what we're really looking at systemically.
All right, very interesting. Frances Stacy, thank you so much for joining us. Frances Stacy, she's the chairwoman of the Global Digital Finance Committee, joining us from Tampa, Florida via Zoom. Taking a look at the rates here again, we got the 10-year Treasury up a little bit here, up about 3-4 basis points, 3.81, but we've had yields come down to 2-year, just on the short end of the curve. We're at 3.67%. Just several months ago, we were at 5%, so a big move down in rates, and that means move down in mortgage rates. We're close. We're right at about 6% on that 30-year fixed. The question is that enough to kind of start clearing the market? What's it going to do to mortgage-backed securities? Erica Edelberg joins us. She's a chief mortgage-backed security strategist for Bloomberg Intelligence here. All right, we're getting 30-year mortgage rates. They're coming down. What does that mean for your business? They're still high relative for most people, but relative, they're coming down.
Hi, thanks for having me on. Yeah, it's getting interesting in the mortgage market for the first time in a while, both from the consumer standpoint as well as the investor standpoint. Basically, rates are the lowest they've been in almost 2 years now, which means that a lot of the people who took out mortgages to bought homes in the last couple of years might start to look at refinancing those mortgages. But keep in mind, there's a cost involved with refinancing. And so, for those who are planning on being in their homes for a while, that makes sense. For those who can roll those costs into the mortgage rate and get a little higher mortgage rate, it also makes sense. But it does mean you probably need about 50 basis points to even begin to think about that. And that's still a relatively small percentage of the market from a mortgage banker perspective. Now, if you're one of those investors who owns those higher coupons, it's going to start affecting your relative value quite a bit. And as a result, we're seeing some of the high coupon mortgages underperform a little bit. They were among the worst performing mortgages in the sector in the past month or two.
Yeah, Erica, I am at a 7 1/8 right now, and I closed last year. So should I wait? I mean, if we're penciling in 6 rate cuts over the next 6 months, like you mentioned the costs that are associated with refinancing for the people who are in the same situation that I'm in.
Yeah. I mean, would I expect mortgage rates to come down a little bit?
I'd get a noose.
The thing about mortgages is they're going to be a little more dependent on the long end of the market. So that's going to depend on what happens with the economy. If the economy really begins to get a little bit weaker, then we might expect the Fed to cut rates more quickly, which probably also means the long end starts to come down a little bit in anticipation of lower rates for longer. If, on the other hand, we have a little bit of an acceleration in the economy or inflation picks up, not kind of most people's base case, that probably means that people think that the Fed doesn't cut as much. The long ends might kind of stay stuck a little more where they are. I mean, we still have a relatively flat yield curve. So as a result, we could expect to see very reasonably some steepening in the yield curve, which kind of restricts how much mortgage rates may fall. On the other hand, if you can roll those costs successfully into the new mortgage rate and still have a lower mortgage rate, then you can kind of keep doing that. It's kind of a free option to refinance. Well, not free, but
All right, looking at the INGO function on the Bloomberg terminal for the Bloomberg Index browser, my Bloomberg U.S. Mortgage-Backed Security Index total return up 4.67% this year. So you guys are actually making some money this year. When you talk to your clients, what are they doing here in the mortgage-backed securities market these days?
You know, a lot of them are a little bit concerned about refi risks picking up. So a lot of them are looking at ways to protect themselves from that. They're looking at the specified pool market, which is a pretty big part of the market, and also the index to maybe buy some extra protection. If you can buy some loans with lower loan balances or higher LTVs, higher FICOs, you know, that might be the way to go. Ginnie Maes in particular, extremely refinanceable right now for just the generic market because there's something called streamlined refinancing there, where basically the rates that you can get are very low because they don't have to underwrite those loans again. And so a lot of the mortgage originators are really taking advantage of that. So those are at risk, and Ginnie Mae higher coupons are really underperforming. So people are trying to find ways to protect themselves against that.
How, if at all, can you compare what we're seeing now or could be seeing to what we saw back in 2020 when rates were plummeting and everyone was refinancing?
Yeah, I mean, obviously, so many people are still locked into those lower coupon mortgages. I think right now only about 10% of the conventional market and about 20% of the Ginnie Mae market will even think about refinancing. But there's so many interesting things in this market right now. Rates rose so quickly that not that many people locked in rates in the 3 to 4 to 5% range. So as a result, it's going to take probably a very unlikely move for most of the mortgage market, most of the homeowners to want to refinance. And there's going to be a little gap in the middle where not much is changing from a convexity standpoint in the mortgage market.
And John Tucker, I financed the Jersey Shore compound at 6%. So I'm going to wait I was hoping for a 4 handle. So I'm going to have to wait a little bit for that.
You may have to wait a very long time.
I may have to wait a long time for that. See? Dashing my hopes right before my eyes.
I feel so bad for Bailey.
At least Alex isn't here. Alex is always like, I think she's at 2.5%.
2.75%. John's at 3 and whatever.
3 1/4.
3 1/4. All right. So I'm not so bad. At least I'm not like the biggest loser.
You can keep me in your circle just to feel good.
Erica Edelberg, thank you so much for joining us. Erica Edelberg, she is our Chief Mortgage-Backed Security Strategist for Bloomberg Intelligence. Joining us here in our Bloomberg Interactive Broker Studio. 30-year fixed, right around 6.1%. Keep an eye on that. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. You have a couple of dynamics taking place today. The prospect of the escalating conflict in the Mideast. Speaking to reporters outside the White House, President Biden asked if he'd support Israel striking Iran's oil facilities. He responded, quote, "We're discussing that," end quote. So crude oil continues to push higher. Energy, the best performing industry group in the S&P 500. We also had a positive reading on the services activity. That's the biggest part of the economy. And then add to the mix, traders also waiting for tomorrow's jobs report for clues on the future direction of rates. Most actively traded stock right now, shares of NVIDIA up 3.5%. The CEO says demand for its Blackwell chip is insane. Amy Wu Silverman at RBC Capital Markets says investors can be certain of at least one thing going forward. There's going to be plenty of uncertainty.
Over the last 20 years, October tends to be a month where we get drawdowns. It tends to be a month where volatility spikes. And to some degree, we're already fulfilling that with the VIX now closing in on that psychological 20 barrier, which typically signals greater fears in the market.
Right now, the VIX 1969, just a hair's breadth away from that psychological level of 20. S&P 500, 4 points lower, 5705 in the index. The Nasdaq Composite Index up 18 points. That's a rise of about 0.1%. And the Dow Jones Industrial Average 169 points lower, down about 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Bailey.
Very good.
I almost
John
said
Tucker.
Barry.
Yeah, we're getting there. We're getting there. All right, John Tucker, thanks very much. We got Bailey Lipschultz sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, doing that streaming thing on YouTube as well. So you can go over to youtube.com, search Bloomberg Live Radio. We got our good friend Barry Ritholtz, host of Masters in Business on Bloomberg Radio. He's also got a day gig. He's a founder of Ritholtz Wealth Management, and he joins us here. Hey, Barry, I'm looking at oil here. I know you're not necessarily the oil guru or anything, but I guess if you're looking for the market to say, hey, we're concerned about what's going on in the Middle East there, I don't know, stock market doesn't seem to care that much. How do you put something like rising Middle East tensions into the mixing bowl of thinking about these markets?
You know, you really have to do a compare and contrast with 2020s versus what took place in the 1970s when we had the Arab oil embargo. The United States is the single largest producer of oil in the world. We have the greatest reserves. Now that we're using fracking technology, we're a net exporter. So, 10, 20, 30 years ago, what happened in the Middle East was very important to our ability to get energy and oil, which is the lifeblood of the economy. Now we kind of shrug and say, yeah, we got all the oil we need right here at home. You guys try not to blow up the world. And that seems to be how the market is taking this. P.S. You saw the exact same thing happen during the first year of the Russian invasion of Ukraine. There was a little blip, and then the rest of the year, Texas crude prices kind of drifted lower.
From a market's perspective, looking at stocks, how do you price in the risk of that Middle East war evolving just in a kind of backdrop where we are seeing the Fed, at least on paper, continuing to cut interest rates, and it does seem like they're going to navigate a soft landing and avoid a recession?
I don't even attempt to price that in. It's actually totally impossible. Think about all the variables you would have to account for to figure out first and second and third level effects. We don't have quantum computers yet. Once we have them, it'll take a few years before they can get that done. Nobody has any idea all the various permutations. It's just one of those random things that you kind of hold off in the background and say, yeah, this is a potential issue, but I haven't the slightest idea how this is going to play out, and anybody who tells you they do is lying.
Barry, here's my open-ended question of the day. What are you working on these days? What are you writing about?
I've been working on a handful of things. I've been having along the same lines of that in terms of not really understanding complex situations when we assume we do. you know, just last week it was the, I think, 55th anniversary or 60th anniversary of the Beatles' Abbey Road. And I went back and looked at some history to try and figure out how the Beatles' initial appearances in the U.S. were perceived. And what did the Beatles have to do with investing in markets? Well, arguably the greatest band of all time with one of the most amazing discographies and enormous influence to this day, a half a century plus later. The initial reviews of their appearance on Ed Sullivan was terrible. The reviews of a number of their best albums, the White Album, Sgt. Pepper's, Abbey Road, they were pretty mixed, pretty mediocre. And it just goes to show you how bad we are at forecasting either what the public's going to like in a year or two, or even you're handed the greatest recordings in history, and a lot of the reviewers couldn't wrap their head around it. And so you end up with a very, you know, talk about complexity and challenging. Anybody who thinks they know what the outcome of the Middle East war is going to be on oil and stock markets, if you couldn't watch the Beatles on Ed Sullivan and say, hey, this is really changing everything, this is groundbreaking, if most of the experts couldn't figure that out, how are experts going to figure out anything as complex as a Middle Eastern war attached to a Russian invasion, attached to a slow shift to hybrid and electric vehicles? I mean, we should be a little more humble in our attempts at forecasting the future.
Barry, one area that investors are jumping over one another to invest in is AI. We saw the massive round for OpenAI. Wow. We see NVIDIA right now up 3.5% on Jensen Huang saying that the demand for Blackwell will be insane or is insane. How are you viewing some of the moves we've seen for public companies, but also some of the checks that are being written in the private markets?
You know, someone's going to be the big winner here. It certainly looks like OpenAI is a leading candidate. What was that last round done at $157 billion valuation? I think that makes them either one of or the highest value privately owned company, certainly in the top 5. So that's just a wild number, raising $6.5 billion at that valuation. Look, when we look at other transformative technologies through history, it's very hard picking the winners in advance. Think about computers or the internet. You know, do I have to mention Gateway or any of the other companies that have kind of come and gone? Once great HP and even Dell went through a number of permutations. It's really hard to figure out, hey, we know this technology is going to change everything. Which are the companies that are going to be the winners? When you look at the internet, what's really interesting is not the couple of dozen companies that have been so successful, like Google or Facebook or even Apple or Microsoft, but how the internet has affected every other company that's out there that's publicly traded. And while there's, I don't know, half a dozen AI companies in the S&P 500, I'm really more intrigued as to what it means for the profitability of the remaining 495 companies in the S&P. Because if those companies can become more productive, more efficient, more profitable, it obviously argues for eventually higher stock prices.
And one company that appears, at least the market's saying, that is not going to benefit from AI is a company like Intel, down 55% year to date. And that's kind of the market, I guess, telling you that at least in the short term, they don't seem to be a beneficiary. Maybe they missed it, going back to Barry's comment there. Barry Ritholtz, thank you so much for joining us. Barry Ritholtz, he's the host of Masters in Business on Bloomberg Radio. He's also the founder of Ritholtz Wealth Management. Great podcast, that Masters in Business. So go check that out anytime you get your, wherever you get your podcast. He's joining us today. That was wonderful. We always talk to him every Thursday. Again, looking at the markets, the S&P 500 is pretty much unchanged on the day. We've got the Dow off 150 points. That's about 0.3%. Yet the Nasdaq's up a little bit here, up about 0.1%. Where you're really seeing the action here is in the commodities. Oil, Brent, is up 3.75% here today, $76.60. And we also got WTI crude oil up about 4% here, just under $73 a barrel. So some big moves over the last 3 days. As we see this ratcheting up escalation of Mideast tensions, maybe bringing the Iranian oil infrastructure. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, folks, it is Hispanic Heritage Month, and every day at this time, we are celebrating significant moments in Hispanic heritage. Now with your installment for October 3rd, here's Bloomberg's Sebastian Escobar.
Thank you, Paul. On this day in 1965, President Lyndon B. Johnson signed the landmark Immigration and Nationality Act of 1965, better known as the Hart-Celler Act, into law from Liberty Island, New York.
This bill says simply that from this day forth, those wishing to immigrate to America shall be admitted on the basis of their skills and not because of the land from which they sprung.
The Immigration Act ended a quota system established in 1924 that numerically restricted immigration visas by favoring those from Northern and Western Europe, essentially excluding immigrants from other parts of the world. Coming off the backdrop of the Civil Rights Act the year prior, this bill gave priority to highly skilled immigrants and those with family already living in the United States. The act also helped the U.S. become more diverse, with the Hispanic and Asian American share of the population more than quintupling since 1960. So today, we remember the act that greatly transformed the ethnic and racial makeup of the United States. That's today in Hispanic Heritage. I'm Sebastian Escobar.
All right, Sebastian, thank you so much. We appreciate that. Sebastian Escobar giving us our Hispanic Heritage moment of the day. Here's a story that I really like, Bailey. We were talking about OpenAI raising $6.6 billion in equity and an evaluation $157 billion. And they had like an A-plus list of investors coming in. That's not all they did. They also got a $4 billion in credit after raising that money. So OpenAI has tapped global banks for a $4 billion revolving line of credit on top of its recent $6.6 billion fundraising, building a massive war chest to stay ahead in the costly race to develop more sophisticated artificial intelligence. The company said it worked with JP Morgan Chase, Citigroup, Goldman Sachs, Morgan Stanley, and several other banks on the credit line. So everybody's behind this company.
Everybody's behind the company, Paul, and that is a ton of cash. When I talk to private investors who are maybe investing in competitors or have a stake in OpenAI, they just point to the fact that running these companies, running these large language models is so capital intensive that you need so much money that you need to continue to tap investors privately. Obviously, you have $4 billion revolving line of credit adds to, as you mentioned, the $6.6 billion raise. But the big question is, what would the next step be for a company that is bigger than Uber as it relates to valuation, and a company that is sitting on, again, $10 billion to spend?
Yeah, I mean, I love to, we were talking to Anurag Rana about this. I'd love to get a glance at their financials because, again, you think of a $157 billion valuation. They're raising, billions of dollars in a revolving credit facility. Every investment bank on the planet is tripping over themselves to do business with them. It seems like every private equity company, or not every, but many of the leading private equity companies, including some of the strategic players like Microsoft, are investing in this company. And you'd like to see what the revenues are, the profitability is. Is it profitable? So when they do file some statements with some financials, that's going to be very interesting.
And it's going to be a lengthy document, I think, back to ARM going public last year and the amount of risk factors we dove into, how they're positioning the company. That's a company that benefits from this AI kind of craze within the chip space. And the big question, Paul, that I keep talking to investors about as it relates to OpenAI is how are they thinking about competition? How are they thinking about Anthropic? Elon Musk's XAI, as Anurag made the point earlier, Bloomberg News reported that the team at OpenAI is actually kind of trying to push investors and people who got into this last round to avoid their competitors, to not try to buy and play multiple companies. And again, it's a big question of who ends up winning, what does this kind of field look like, and what will be built on top of these.
Yeah, and the question is, and I know you have to deal with this as an IPO reporter, companies like OpenAI, they don't need to go public. They can get plenty of capital everywhere, both in the equity markets and in the fixed income markets, like the credit markets. So they don't need the public equity capital as a source of capital per se. So I don't know.
No, and I think the big question comes back to, and this is top of mind and has been top of mind for a number of companies that are still private over the last 3 years, with the IPO market being touch and go, is if you're going public, to your point, what is the reason? Do you want to give employees access to capital, or do you want the branding event and to be able to say you trade on the NYSE or you trade on NASDAQ and here every day is what we're worth? Because there are headaches that come with being a public company.
And one of the things we've had, particularly in the technology space, that would work against coming public is getting a lower valuation in the public than you've gotten in maybe your recent private deal. That dreaded kind of markdown, if you will, in valuation, a down round in valuation. But it doesn't seem to be an issue for this company. So other banks involved in the credit facility include Banco Santander, Wells Fargo, Sumitomo Mitsui, UBS, HSBC Holdings, so global banks lining up for this credit facility. So last 2 months, 3 months of the year, are we going to get some more IPO activity, do you think? Or is it contingent upon, I guess, the elections and other things?
We have a pretty stacked calendar, actually, for the rest of this month. I say stacked just with the caveat that we're nowhere near what pre-pandemic era looked like. But we are seeing a number of sponsor-backed, PE-backed companies going public. Partners Group is taking KinderCare public. Move Lubricants, which is a unit of Kosan, Count CVC is an investor. They're going public. Cerebras is in the AI chip space. They recently filed, as did Ingram Micro, which is backed by Platinum Equity. So we're seeing a number of deals approaching the finish line this week and next, trying to get ahead of the election kind of shutdown. The big question is, what does this look like post-Thanksgiving with a narrow window ahead of the end of the year and holidays?
Yep. All right. So hopefully they can get end with a little bit of strength here. S&P 500 down 3 points. The Dow off 150 points. That's 0.3%. So a little red there, but we got some green with the NASDAQ up about 26 points. That's 0.1%. 10-year Treasury yielding 3.82%. That's up about 5 basis points. But of course, it's the global oil. WTI crude oil up 4.3%. That's $3 a barrel. We're now over $73 per barrel. So continues to see movement in global oil. Balance of Power with Joe Matthew from Washington, D.C. That starts right now.
From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
President Biden says striking Iran's energy complex is on the table. Welcome to the fastest show in politics as oil prices rally today. On the president's remark, we'll consider the impact on the campaign with Bloomberg's Laura Davison, also tracking Biden to Florida today, where he's surveying hurricane damage. The Trump campaign responds to the unsealing of special counsel Jack Smith's report on election interference. We'll discuss with criminal and constitutional law attorney Robert McWhirter. And strange bedfellows today on the trail. Kamala Harris sharing a stage with Liz Cheney in the birthplace of the Republican Party. We'll have analysis from our political panel, Jeannie Shanzano and former RNC Communications Director Lisa Camuso Miller. It's all after a check on Wall Street. Let's get to the markets first right now with Charlie Pellet in New York. It's all about oil today, Charlie.
Indeed. Let's begin with the oil quote because we got West Texas Intermediate crude above $73 a barrel, 73.14, up now by about 0.4%. Brent, the global benchmark, up by 4.1%. Crude oil and the dollar extending their gains today. We've got oil surging after President Biden told reporters he is discussing if he will support Israel striking Iran's oil facilities. Stay with Bloomberg Radio for the very latest on this developing story. Again, crude oil bears repeating, up now by 4.3% with a $73 handle. S&P lower by 3 points, down by about 0.1%. We have got the Dow down 144, now down 0.3%, and NASDAQ up 27 for the NASDAQ Composite Index, a gain right now of 0.1%. 10-year yield 3.82%, the 2-year 3.69%. Gold down $9 the ounce, down 0.4%, 26.49, and again crude oil up by 4.2%. Well, certainly a major factor for investors, the November election. Afen Devitt is Chief Investment Officer at Moneta.
This election is very much binary in terms of what's likely to happen around the impact on trade, trading partners, and tariffs equals inflation and GDP compression across the world. So that is going to have negative impacts.
Devitt was interviewed this morning on Bloomberg Open Interest. So again, oil bears repeating up 4.2%. Oil stocks, though, trading mixed. ExxonMobil right now up 0.5%. ADRs of BP down 0.4%. Chevron up by 0.4%. Again, recapping, looking at a mixed day for stocks. S&P down 3, a drop right now of just about 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Balance of Power continues. Back we go to Washington. Once again, here he is, Joe Matthew.
Okay, Charlie, thank you so much. Always doing a great job at World Headquarters in New York. We'll stick with Charlie on the markets throughout the day today. Things are moving after the president spoke. And this is just another element to add to the pile of news that's impacting the campaign trail. Following the candidates today, Joe Biden himself, of course, not a candidate, but has left the bubble. He's today down in Florida, just arrived in Tallahassee, and will make his way to Perry, Florida for an aerial tour of the areas impacted by Hurricane Helene. He's got an operational briefing, kind of like what we saw yesterday in the Carolinas. Then he's going to deliver remarks before heading back to the White House. Kamala Harris, meantime, heads for Oshkosh, Wisconsin, for a campaign event that she couldn't have possibly imagined 4 years ago. Sharing a stage with Liz Cheney in the birthplace of the Republican Party. Ripon, Wisconsin, am I saying that right? Somebody set me straight. Their first event together. Since, of course, Liz Cheney endorsed Kamala Harris, knowing that they had literally nothing in common politically until Donald Trump. Now, everyone, including me, keeps asking, what's the October surprise? And I think maybe a different way of asking might be how many we're going to get. As we add another log on the fire here with Jack Smith's report unsealed yesterday. We're awfully lucky to have Laura Davison with us, of course, editing Bloomberg politics coverage here from Washington with her eyes on the campaign trail. It's just drinking from a fire hose every day for your team, isn't it?
It's one thing after another. It's hurricanes. It's now the Middle East, quite literally blowing up. Things are coming on.
I haven't even mentioned Israel yet. Exactly. So you want to start there. Joe Biden, I don't want to dwell on this too much, but we're looking at crude oil prices rally on this comment that he made, that attacking Iranian energy installations is being discussed. Did he want to say that?
I'm not sure that he did, and we may hear some more clarifications later today. Based on obviously that has market impacts as well as geopolitical impacts going forward. But this is clear that the Middle East is going to be more of an issue, not less of an issue, over the next months. As tensions are rising there. This is not what Joe Biden nor Kamala Harris wanted.
Well, and from your view in the campaign, Kamala Harris is sure to be asked about this, right? She's part of the administration. Everything Joe Biden says ricochets on Kamala Harris.
Yes, and it's it was no accident that the first question at the VP debate earlier this week was about foreign policy. We have two wars going on right now that no sign of ending and potentially ratcheting up in terms of lives lost and all these other metrics.
Sure. Well, she'll have her opportunity, I suppose. But let's talk about a little bit about this today. Can you imagine a world in which Kamala Harris and Liz Cheney, do you think they ever even spoke when they were serving in the Capitol at the same time?
Seems unlikely.
I mean, political enemies, we can say that, right? On just every issue. And yet here they are together sharing a stage on the trail. Who's going to buy this?
We'll see. I mean, Wisconsin Republicans, Liz Cheney has a certain appeal there. They remember this is also the state of Paul Ryan and some other more institutionalists who want to see, the sort of institution of Congress and the presidency survive in the way that we've grown accustomed to it being. And this version of Trumpism is not appealing. But this is going to be a real interesting dynamic to see how they are personally engaging, as well as how the crowd reacts. Are these, do you have